Now we are in part two where there is too many formulas. And of course, the favorite part is equity and fixed income, right? Now, this is where you have major concentration in terms of weightage also and a lot of formulas. We'll first start with equity. I hope you have our part two book and I will walk you through the topics individually so that you are aware where the formulas are. The most important formulas are related to leverage, even though we did that in cons. In cons, we did the leverage, right? So we are starting with reading number one. The most famous formula is the leverage returns. You guys can help me in that. There are three formulas related to leverage return. There's just a correction here, which is necessary to mention. I think in some of the book it is corrected. In some of the book it is not. So I will rewrite the formula. Leverage ratio is nothing but 1 over the initial margin or equity margin, right? So first formula we will write is of leverage ratio. So 1 over equity. Equity is what? Your proportion or initial margin. Write down with me. 1 over initial margin, or you can also say the equity component or own fund. Different names: initial margin, equity fund, own fund. That's your leverage ratio, how many times the leverage it is. The second formula, which we already did in quants, is leverage returns, but I will discuss that later. There is something called call price or break-even price. Can someone tell me what is this call price? Call price, I also call break-even price. Why? Because this is the point at which the margin call will trigger. So you always take the current market price, that is P0, into 1 minus some margin over 1 minus some margin. So what are the two types of margin? Initial and maintenance margin. So we will do 1 minus initial margin, 1 minus maintenance margin in the denominator. That will give you the break-even price. Remember, this is the price at which you will get margin call. All right, very important. Understood, everyone? Yes, keep responding to me so that I know you guys are there, active, energetic. Come on, last couple of days, you have to be very energetic. Whatever helps you. I don't mind. Orange juice, Red Bull, whatever helps you. All right. Next is leverage returns. Leverage returns and leverage returns. This is similar to what we did in quants, but now here we will write it in the manner that is needed in equities. So here I write two things: NSP, net sale proceeds. NSP is nothing but net sale proceeds. It's like your ending value of investment divided by the beginning value of my investment, and that is called my initial investment. So NSP, net sale proceeds, over initial investment, that is ending over beginning, minus 1 into 100. Simple formula it is. Ending over beginning minus 1 into 100. The name changes, but then definitely your mind will be like, sir, what goes into NSP and initial investment? So now I will write what goes into NSP and what goes into initial investment. I'll repeat: NSP is net sale proceeds and initial investment is your initial cash outflow. Now what I'm going to write is something that I have derived it. This is not an official formula, but it covers every aspect. So what is NSP? When you sell the fund, what do you get? You get the sale price or the selling price. Okay, the selling price of the fund. This is number of shares into the market price. Which number of shares? Ending share price into number of shares. That's your sale price or selling amount. Clear? Everyone with me? P1 is the price when you sell and number of shares. From this, have I invested entirely my money? No, there is a borrowed fund, right? So first we will pay the borrowing. So from this, we will pay the borrowing amount, and along with this, we will pay interest on borrowings. Correct? Everyone with me on this? Both we will pay, but if there is any dividend received, that will be considered a inflow. So dividend received will be added. And one more thing is subtracted. Can you help me understand? Yes. commission on sale. Commission on sale. Commission on sale. Now, many students who have not learned from me, they get surprised. What is this? But this is NSP components. What do you get when you exit the fund? This is like your cash inflow after everything. All right, everyone in the class understood? Y plus Y minus all of this is going to be my net sale proceeds, like a cash inflow. Initial investment, when you invest in the fund, there are only two amounts that you pay. That is your initial margin, right? That is the proportion that you have to invest, correct? And you pay commission on purchase. But remember, since we are calculating initial investment, it's an outflow. So my commission will be added here. I hope you understand why, because I'm calculating the outflow. So when I'm calculating the outflow, commission on purchase is going to be added. So that's my initial investment. This is my homemade recipe, guys. This is not the official formula, but I am pretty much sure that this will cover every component that goes into leverage returns. Clear, everyone? Understood? Return. I'll write the components. Sale price, when you sell it off, borrowing amount, interest on borrowing, also outflow, dividend inflow, commission while selling, outflow, NSP. Initial investment, that is your initial margin, and commission, both are added, both are outflow. That goes into denominator. NSP is the inflow on the numerator, like ending value, ending over beginning minus 1 into 100. Leverage returns. Very important. Everyone understood this? Check and confirm. Check, confirm, check, confirm, check, confirm. All right. Yes. Now we'll go to reading number 2, where you have index related formulas. Now, index return is similar to your holding period return. First of all, when they say price return of an index and total return, again, you will notice I'm using the same formula. And see, this is how CFA is easy sometimes, because we think there are too many formulas. Not really. It's the same formula, different names. So price return is nothing but ending minus beginning price. So we write P1 minus P0 over P0, right? Or you can simply say ending over beginning minus 1. So we write this into 100, or you can say ending over beginning minus 1. I prefer not this. I prefer, again, this is not, no problem in this, but I prefer this ending over beginning minus 1 into 100. I prefer this shortcut. You can do whichever formula you want, okay? Doesn't matter. This price return just takes price difference. Total return will also include dividend, isn't it? We are doing equity. So I will add the dividend. So along with ending price plus dividend over the beginning price minus 1 into 100. That will be my total return formula. Is that clear, everyone? Right? Now, this is for a single period. If I want to find, check out very interesting thing. If you want to find an index value at the end of a period, let's say at the end of 3 years, then what you will have to do, you will have to take the index value at the beginning and compound it with the returns. So you will compound that with return 1, compound that with return 2, compound that with return all the way till T years. Are you with me on this? What is this going to give me? This is going to give me the future value of my investment. So this is going to give me the future value of my index. All I just did is compounded the index value. So let's say today the index value is 100. You'll add 5% in first year, 10% in second year, 15% in third year, etc. And what will be the index value after 3 years? It's not a formula, but I'm just telling you how it is used. Understood, everyone? Clear, 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 clear. Price return, total return, index value, value at the end. Now, see, when I say returns here, it doesn't matter. It can be price return or total return. They will ask you accordingly. We'll put up. All right. Now, remember the four weighing methods: price weighted, equal weighted, market cap weighted. Now, even though it doesn't have a formula, but there are some components which I will tell you. This will help you understand how to value a price weighted index. So we are calculating what? Returns for price weighted index, equal weighted, and market cap. Now, in this case, for price weighted index, remember for price weighted index, how do we find the index value? We have to find the index value. So I will write price weighted first. And this are important tips. Price weighted index. Remember, price weighted assumes what? Assumes what? One stock of each one stock of each securities in the index. So under the price weighted index, what we do, we just sum up all the price and divide it by n. That is how you will get the index value. Are you with me on this, everyone? How do we get the price weighted index value? Just sum up all the price, divide by n, divide by n. Understood, everyone? This is how you get price weighted index value. Equal weighted, equal weighted. Now in equal weighted, remember, each securities you will calculate what? Equal weighted returns you will calculate first. So you will calculate return for security 1, return for security 2, return for security 3. Let's say it's 3 years, 3 securities, and then simply divided by n, the number of securities. That's how you get equal weighted returns. Price weighted, what will you do, guys, to get the price weighted value? Add all price, divide by n. That's it. That's how you get the beginning and ending value, and then calculate the returns. Equal weighted, each security, you will calculate return, holding period return, ending over beginning minus one for security 1, 2, 3, and then do a simple average, mean. My favorite is market cap because most of the indexes in the world are market cap. Now, market cap is also called value weighted. Now, first of all, what is the formula of market cap? Market cap is number of shares into the current market price. But what if they give you free float? If they say free float market cap, then you will have to multiply with the float factor. Everyone, float factor will be provided to you. If they say float factor of 1, that means 100%. That means all the shares are public. All the shares are available to buy, sell. But if they say float factor 0.9, you will put here 90%, that is 0.9. Your market cap will reduce. This you will do if they say free float market cap. Once you calculate the free float market cap for all, right? Just that value, divide by, that's the beginning value, then the ending value. Simple. The formula is simple for holding period return. Just that how to derive market cap is a problem. Once you get the market cap for one security, add the market cap for all the securities. That will be your beginning market cap of the index, then the ending market cap of the index, and simple holding period return. Is this clear? All the formulas? Price weighted, equal weighted, market cap, or free float market cap. Anyone has any doubt here? Check, confirm. All good. Next, in reading number 3, do we have any formula in reading number 3? No. In reading number 3, I have told students the most important thing is weak form, semi-strong form, strong form efficiency. That is one of the most important things. Reading number 4 is overview of equity security. Here, many of the formulas you will see are repetitive, something that you have already done in the past. Here, ADR, GDR is very important, I told you. Here, the simple holding period return and standard deviation formula, I'm not repeating it because we already did that in cons. Everyone knows how to calculate holding period return and standard deviation. Am I correct? Right? Some new things are related to price to book value, even though price to book value, we will do it in the last reading as well. So price to book value ratio, we can write it down here as well. But the very important thing is, what is the book value calculated? It is calculated on average or not. So we go to this reading. In this reading, price to book value. I will repeat, price to book value is going to be repeated, but still, what is price? Market price of the company, and book value is equity value of the company as per the balance sheet. Now, market value or book value, we always do in per share. So we do market price per share, book value per share. The important thing is which book value. And that book value importance is related to calculation of ROE. ROE also has something similar. When I say ROE, we've already calculated this. ROE is what we call net income over total equity. Actually, total equity is nothing but the book value, isn't it? Total equity, book value, same thing. So what is total equity? It is book value. Book value. But which book value? We always take average of the total equity. Why? Because we're comparing an income statement with a balance sheet. So in the ratio, whenever you compare income statement with balance sheet, you always take average. But for average, I need the ending value, ending book value, and I need the beginning book value also, isn't it? Ending and beginning book value. Book value, I will repeat, is nothing but the equity value of the company based on its balance sheet. I need the ending and beginning book value, and I will take the average. Remember, students, if you have both, take the average, right? If not, you will take the beginning value. If not, you will take the beginning value because we invested equity and on that, how much returns we got. My personal suggestion is that the institute will mention this, but in case if you have both the values, preference number one, always go for average because that's an technically correct. If you have only one, what else will you do? Understood? Come on, guys. Clear? All right. If you have one, what will you do? Guys, come on. Yes. Honestly, you won't believe in level two, we have a concept called compensation expense, where if you don't have the ending value, I will explain you in level two, but in that, if you don't have the ending value, you have to assume zero. Now, imagine if you assume zero and then they ask you to calculate the average. So actually the value goes half because let's say beginning value you had 100, right? And if ending value you take zero, what is the average of both? 50. So I also sometimes wonder, what is this? So I tell students, you have to be specific. Yes, your doubt is not silly. I actually understand this because this in level two, this is an important thing. So yes, if first of all, if we don't have a choice, we'll use what value they give, but not in level two. In level two, the strategy, the game is different. I'm just introducing you what's coming up, right? Okay. Everyone clear with price to book value ROE online, guys? Hello? Okay. Cost of equity, we have seen cost of equity so many times in working capital, in corporate issuers, and so many places, right? Actually, cost of equity, we will discuss in detail later on. There are multiple ways to do so. The most common method that we use in level one is the CAPM approach. There is another approach called the Gordon's growth approach also. We will discuss that in the last reading. Both are used to derive cost of equity. Cost of equity is nothing but you as per CAPM, even though we have to write it double, triple times, no worries. Let's write it. It is RF plus beta into RM minus RF, which is called market risk free, market risk premium, anything above the risk free. Using the Gordon's growth, what we do is that we rearrange it. We rearrange it. So what we do, we write D1 over P0 plus G. D1 over P0 plus G. Don't worry about the explanation. We'll do it when we do the last reading. All right. This is just for you in case if they ask you find the cost of equity using Gordon's growth. So we can rearrange the formula. Remember the original formula is P0 is D1 over R minus G. R is nothing but cost of equity. This cost of equity and its weight along with after tax cost of debt 1 minus T along with its weight will become your WACC. Understood everyone in the class? Check 1, 2, 3. Right? Again, we are just repeating what we did in corporate issuers. Clear? Any doubt till this point? Check 1, 2, 3. All right. Yes. Many times you see the formulas being repetitive. That's okay. Now, in reading number 5, is SD given instead of beta? Is SD is given instead of beta? I didn't get it. SD, beta? I didn't get it. Where is standard deviation here? There's no standard deviation here. Beta we discuss. Beta is covariance over variance, right? We discussed that in uh, quants. We will discuss that in portfolio again. Now, everyone, in reading number 5, there is an important element which is very rarely discussed, rarely asked, but let's do it. We use the operating profit using a different way of fixed and variable cost. And based on that, the two ratios which are important for you is degree of operating and degree of financial leverage. So this is where first thing I will discuss about this is what is the difference between sales and variable cost? Everyone in the class, sales and variable cost. Sales and variable cost. When I subtract sales minus the variable cost, we call it as contribution margin. We call it as contribution simply or contribution margin. All right, everyone. From this, we subtract the fixed cost and we get EBIT. Then we subtract the fixed financing cost, that is interest. And then you get EBT. Now, why am I doing this? This helps you understand the easiest formula here is degree of operating leverage is due to fixed operating cost. Degree of financial leverage is due to fixed financing cost. So how do you need to remember? Do you remember the technique that I told you to understand this? How do you find degree of operating leverage? Take an item before fixed and after fixed cost. Yes, before fixed cost, contribution, after fixed cost, EBIT. Before interest cost is EBIT, after interest is EBT. Is this clear to the class? Everyone understood this? Check and confirm. This is your degree of operating leverage, degree of financial leverage. You are required to know the static formula only. The dynamic formula, I've used it because previously, 3 years back, you had a reading on leverage. So where we use the dynamic formula, we draw a table, we find the new income statement. That is what we used to do. So yes, this formula you need to know. Everyone okay? Hmm? Yes, operating profit. So here, how did I get the operating profit? Check here. How did I get the operating profit? Operating profit is nothing but your EBIT. See what we did. From sales minus variable cost, we get contribution, correct? From that, I will subtract the fixed cost. But see, everything is in per unit, right? If you want to find in total unit, sales minus variable cost, you will multiply with quantity. That will be your total contribution. From that, you will subtract the total fixed cost. That will be your operating profit. Okay, same thing. I just did vertically. Understood? So check out this sales minus variable cost into quantity, sales minus variable cost, that is price minus variable cost into quantity minus the fixed costs. All good, everyone? Now, reading number 6 as such doesn't have calculation, but we all know the concentration ratio we did in economics, right? Below 1500 is low concentration, moderate between 15 to 2500, and about 2500 high concentration. Everyone knows that? Clear? Right? Okay. Reading number 7, actually, it's not a formula, it's a simple way of calculating cost of goods sold. Cost of goods sold are dependent on revenue. So what is the margin? Sales minus cost is gross profit. So if the gross profit is 40%, my cost is 60%. So you take the previous year's margin. This is nothing but what? Previous year margin into the future estimated revenue. So just writing down this formula for your reference, I'll repeat, it is just nothing but rearrangement of income statement. But still, for your reference, you should know what is exactly this. So if I am estimating my cost of goods sold, so first of all, cost of goods sold is some percentage of revenue. So what I will do, I will take the forecasted revenue, let's say next year revenue, multiply with what? Multiply with the margin. So now the margin here is from the past. Margin what? Margin is historical COGS over revenue. That is from the past. So once I do this, I can estimate my future COGS. So you want to estimate your COGS, you can do that. This is your forecasted COGS, right? Very simple. You might, the formula looks scary, but don't worry. It is just simply what? It is simply your past COGS percentage. COGS percentage, that is cost of goods sold, right? Sorry, forecasted COGS. I'm writing wrong thing. Forecasted COGS is COGS over what? Past revenue into forecasted revenue. I'm so scared of writing. I have handwriting dyslexia. As soon as I write, my hand shiver. Huh? Same as doctors. Yeah, I'm a doctor. I am scared of writing. You know, in this, you see my improvised version of writing. My real handwriting is so close to Chinese. What you see right now is an improved version. Maybe. All right, everyone? Correct? Yes. Now, guys, the last topic. And this is where you have all the formulas. Now, I love this topic so much that I'm going to go in a flow of all the formulas. So stop me if you can, but I can't. So one by one, I will tell you what is the ex dividend price. When you declare the dividend, the price of the share goes down. So that is called ex dividend. Ex dividend price is the price of the company before dividend, price before dividend, and simply subtract the dividend. Subtract the dividend. That's it. This happens on the ex-dividend date. As soon as the ex-dividend date comes, the share price should get corrected for the dividend. So ex-dividend price is nothing but the price of the company after dividend. Simple. Okay, nothing brainer here. Now, the rest of the thing is about the three models. DCF model, right? Then the second model is multiples, relative valuation, and the third is asset-based model. I hope everyone is aware and ready. I will write down on a new page. First, I will write down the three models. Everyone knows the three models. DCF model of valuing the company, under which we have dividend discount model, free cash flow based model, right? All of these are based on Gordon's growth also. Then there is relative valuation or multiple approach. In this, we use the price multiples and EV multiples. Remember EV EBITDA ratio? And then there is asset-based valuation model. Under this is the minimum value, floor value, under which we use the NAV approach, net asset value approach. All right. It's in the notes. Don't worry. I've used all the important elements here, dividend discount model and so on. The proper names are presented. DCF model is also called the present value model. So don't get worried when you see multiple names. All right, everyone, ready to write down all the formulas? First thing first, the dividend discount model, single period dividend discount model, and multi-period. Multi-period I will take, let's say, for 3 years. Okay. Same way, this is single period dividend discount model and multi-period dividend discount model. And then I will do what? Then I will do single period or constant growth models. Then I will introduce growth models. In that, I will say constant growth model. And then I will say multi-period stage growth model. Okay. You will see all of these formulas connected in a moment. Correct? Single period dividend discount model. We are investing for one period. Under all cases, what am I deriving? I am deriving the intrinsic value. Intrinsic value, you can say P0, V0, whatever you say, doesn't matter. I will write V0 for simplicity. V0 is, if I'm investing for one period only, at the end of one period, I will get only two things. That is D1 plus P1 and discounted with cost of equity. I will call it R year for simplicity. Everyone clear? Single period, 1 year. But if it is multi-period, then in that case, my V0, let's say even if I take for 3 years, I will need three dividends, D1, D2, D3, and they will provide me the terminal value if it's a multi-period dividend discount model. What is terminal value? It is the value at the point which you will stop valuing, or you will consider the company is growing at forever in the growth rate. In the without growth rate model, that terminal value P3 in this case will be provided to you. You will just do the discounting for the appropriate period. I'm writing the formula, but we don't use this. We use what? The calculator function of cash flow. I'll repeat, I'm writing down the formula, but we don't manually do it. We use the cash flow function. Is that clear, everyone? Right? Constant growth rate model. In that, V0 or P0 is based on D1 over R minus G. And what is D1? Guys, D1 is derived from D0. D0 into 1 plus growth over R minus G. Are you with me on this? Clear? So we all know how to derive D0. R is using CAPM, and G we already know. G is using what? Which formula? Growth is retention into ROE. All good, everyone? If it's multi-stage, I will use the same process that we did. So now from multi-stage dividend discount model, I will go to multi-stage Gordon's growth model. In exam, be ready for 2-stage or 3-stage. So multi-stage, I will write Gordon's growth model. Gordon's growth model. In that, the unique thing is that maybe the company's dividend is growing for 20% for the first 2 years, and then 5% after third year, etc. Multiple growth. The final period after which the company stock will grow at a constant rate forever, that point is called terminal value. And everyone in the class, for P3, for deriving P3, you require D3, right? And how did you get D3? By applying the high growth phase, high growth. But from D3 to get the D4, you will have to apply the constant or normal growth rate. You can call constant or normal growth rate. This growth rate is long-term growth rate. So you can call constant, normal, or long-term growth rate. You can say constant or long-term growth rate. Divided by R minus G. And with G, you have now 2G. So we will take which G? The constant. That is your terminal value if they say that the company will grow at 5% forever. Now, if they say at the end of 4th year, then I will do what? P4. Everyone, P4 will be what? D5 over R minus G. P6 will be D7 over R minus G. That's going to be a terminal value. Is that clear to the class? Everyone understood this? All good? Yes. Check. Now, just one thing. In case if they ask the same component using free cash flow, the formula doesn't change. Wherever you have used dividend, instead of that, replace with FCFE. What we will do if they ask the same concept using free cash flow, I'll repeat what we do. Instead of dividend, we'll replace that with FCFE, FCFE. Are you there, everyone? Confirm me if you understood this. All good? Now, this formula of perpetual preferred shares, we already discussed in quants. In quants, we discussed perpetual bond or perpetual preferred share. We take what? PMT over I by Y. That PMT in preferred shares is preferred dividends over cost of preferred share. In bond, it is coupon over YTM. So no need of this formula to be repeating. Multipliers, yes. In multiplier, you have very important thing, the price to earning, but rest of the multiplier are also important. We will now focus on the different types of multipliers. Now, first thing first, price to earnings ratio, price to earnings ratio, it's either trailing or leading. Trailing or leading. What is the trailing PE ratio? First, I will write down this trailing PE ratio. Trailing PE ratio is where I take the recent earnings, correct? But if I use the forecasted earnings, then the ratio becomes what? Leading PE ratio. In leading PE ratio, the current price, and I will divide it by the forecasted earnings. Are you with me? What is the difference between trailing and leading? It's about the E. Are you doing forecasted or are you basing on the past? Correct. Now rest all price to sales, price to book value, price to cash flow. In that you take everything per share. Okay. So the name itself is the formula, price to book value, price to cash flow. Now, what is the use of it? In case if you want to find V0 using any of this formula, V0 is the intrinsic value of the company. If you want to do it using price to book value per share, you will have to multiply with book value per share. If you have to do it with price to sales per share, you will have to multiply with sales per share of your company. The multiple you can take it of industry, they will provide. If they want you to find using price to cash flow per share, you'll have to multiply with cash flow per share. Same with P ratio. What will I do? If I do P ratio and multiply with the earnings of our company, I will get the intrinsic value. So the intrinsic value with multiple is this. What you do? You take the multiple and multiply it with the variable of your company. Clear? This is the easiest way to calculate or value a company. Am I correct? Most widely accepted. Now, the important thing is that the PE in the PE, the price is which I use actual price. If I use Gordon's growth price, what is the Gordon's growth price? Price over, let's say, leading. If I want to find leading, because we use for forecasting, right? Leading is used for forecasting. Guys, ignore this for a moment. And if I use Gordon's growth, what is my P0? D1 over divided by R minus G. Am I correct? Yes or no? Now, if I just divide both the sides by E1, E1 is what? Leading earnings, right? Then this ratio becomes what? Justified or called as fundamental. Either we say justified or fundamental PE ratio. And this is leading. So I will say this as justified fundamental leading PE ratio. What is this called? Justified fundamental leading PE ratio means why is it called? Because have I used the actual price? No, I've used Gordon's growth price. So what is the final version of it? The final version of it is that price over expected earning, that is justified leading PE ratio. What is D1 over E1? Guys, what is that called? That is called payout ratio, isn't it? Or 1 minus retention, correct? Over R minus G. Is this clear to the class? Confirm? Everyone? Got it, everyone? What is this formula? I just used it for derivation. What is this formula called as? This formula is called justified leading PE ratio, where I use the Gordon's growth price and it is used for forecasting. Everyone, very important. For your reference, I will discuss that what will cause the P ratio to increase. Please tell me, what will cause the P ratio to increase? If the payout ratio increases, will the P ratio increase? Yes. If the growth increases, will the P ratio increase? Yes. But the required return should decrease for the P ratio to increase. Got it? Everyone in the class, check, confirm. Perfect. Now, one thing which is not in the notes, not required also, but still you should know that when you increase the payout, there's a technical glitch there. What? Higher the payout, lower is the retention, lower is the growth. So higher payout will reduce the growth also. So what is the catch in this formula? In this formula, there is a problem. It assumes what when I'm using this formula, what is the assumption? The assumption is that this will happen independently. Means only the payout is increasing, only the growth is increasing, or only the required return is going down. But remember one thing, that naturally what happens that when the payout ratio increases, the retention ratio goes down and the growth also goes down. So it acts contradictory, isn't it? Correct? This concept has a name. Does anyone know the name of this concept? It's not a formula, but does anyone know the name? Yes, anybody? Does anyone know the name? It is called dividend displacement theory. You want, you can write it. It's not a formula, but still, this concept that higher payout will reduce the growth, higher payout will reduce the growth. That is called dividend displacement theory. Is this clear? I'll repeat, it's not a formula, just a concept, but many students might not be aware. Higher payout reduces my retention ratio and reduces my growth. This concept is called dividend replacement theory, because higher dividend will displace your growth. All good? Huh? Dividend displacement theory. Now, the one formula which is needed, similar way, if I do value of equity, but if I want to find the value of firm, what do we do? If I want to find the value of firm, we calculate the EV EBITDA ratio. So if I want to find the value of entire company, we use what? We use the EV EBITDA multiple and multiply that with the EBITDA of our company. Right. Now, EBITDA is very simple. It is earnings before interest, tax, and add the non-cash depreciation and amortization. The important thing is EV, enterprise value, and this is critical. Enterprise value is what? The value of the entire company. So entire company is who provides capital, debt, preferred, and common equity. They provide the capital, right? So what we do is that we take all the debt. So we take the market value, not the book value. We take what? Market value of debt. Debt means long term and short term both. Market value of equity, that is preferred. Market value of common equity. We take the market value of all, okay? Market value of common equity, market value of preferred equity, minus we do what? Cash and equivalents, or cash and short-term investments. Why? Because when you take over the entire company, the cash belongs to you. So remember, everywhere I'm writing market value. Market value is not the same as book value. Minus what? Cash and short-term investments, or you can say cash and equivalents. Cash and short-term investments. Those are your liquid funds, short-term investments that you will subtract. That is your EV, enterprise value. Clear, everyone? Enterprise value, market value of debt, preferred, common, minus cash and equivalents. Divide by EBITDA, you get the EV/EBITDA multiple. Finally, the NAV based approach. Guys, in NAV based approach, what we do, we take the total assets of a company, total assets valued at fair value, minus total liabilities. And the difference is your what? The NAV, net asset value of the company. This is the lowest valuation amongst all the three valuation. Correct. That's it. That's the end of all the formulas of your equity. Nothing more than this. All good, everyone? Clear? All the equity formulas? Equity check, confirm. All good? Yes. Fixed income, a massive 19 reading, right? Okay, the weightage is same as equity. Now, majority of the formulas are actually in the section from where pricing begins. So pricing, and then comes the risk part. In fact, I will say where exactly. See, from until this point, you will see majority of the formulas coming up, right? Especially for the pricing, all the formulas are concentrated till here. Then you have all the risk related formulas. The last six readings and the first five readings have very few formulas. Yes, in case of government issuers or corporate issuers, especially for banks, in that case, we have some repo related formulas, right? So let us go through the formulas one by one through the notes. As you will see, the first couple of readings are pretty much simple. There is no formula as such. You might think it's a formula, it's not a formula. But why? Because they are the introduction of fixed income. Okay. Callable, putable bonds, all introduction is only there. The first formula starts about the repo under the repurchase agreement under fixed income market for corporate issuers. When banks borrow or lend funds, they use the interbank market tool or instrument that is called repo. Under repo, one of the very famous formula is the haircut formula, which is highly testable. All right. But in the class, we have actually calculated all components. That is, what is the purchase price or so called as the loan amount, interest on it, which is called the repo rate, and then the repurchase price. Based on that, we calculate the haircut. Okay. So these four formulas related to repo, repurchase agreement. Okay. First thing first, which is called the purchase price. See, in repo, what you do, you sell the instrument and then you repurchase. So first thing is the purchase price or the loan amount. Purchase price or the loan amount, right? Loan amount is the word that is used because if you want to borrow, you will sell the security, the lender will buy from you and you will repurchase from them at a higher price. So please understand, purchase price plus the repo. Repo is the interest, which is the repo. And when you add both, it becomes what? The repurchase price. Then it becomes the repurchase price, which is always higher. So actually repurchase price is nothing but purchase plus repo. Now what is purchase price? It is based on the margin. So first of all, understand, when you want to borrow, you have to give collateral, correct? So if I want to buy a property of 1 million, I will have to give collateral, correct? Now always remember that the collateral value is more or the loan amount is more. The collateral amount is more. So that will be called here as the initial margin. So whatever is the collateral, that is the market value of security here, we call market value of security or the collateral value. That divided by the initial margin percentage, which is above 100%, because you will always take more collateral, right? That will be your purchase price or loan amount. On that purchase price or the loan amount, whatever is the repo rate, But remember, it can be overnight borrowing also, right? So we do it for the days. So this repo rate for the relevant days. Now, how many days do I consider? Should I consider 360 or 365? Again, don't worry, the institute will inform you. But if not, these are a money market tool. So you will use your 360 days if not mentioned to make it simple. Is this clear? So purchase price into repo rate into D by 360, that will give you the repo amount, or repo is nothing but the interest amount. All right. Together, this two will become my repurchase price. So repurchase price is nothing but the purchase price plus the repo amount, or the repo or the interest amount. Is this clear, everyone, to the class? Right? Everyone, check and confirm. Now, the important formula here is the haircut. For haircut is the buffer before which you will get a margin call. So once the securities value falls, the collateral value falls, that is where you get a margin call here. That is the haircut. So how much is the cushion? So it is simply based on initial margin. You take initial margin, inverse it, subtract it from 1. So you have initial margin. I'm writing in the way that you will calculate. Inverse that initial margin, inverse it and subtract it from 1. That's the easiest way to calculate the haircut. So actually there are three formulas: purchase, repo. Combination of both is called repurchase, and fourth one you can say is haircut. All right. Be ready for something similar to haircut. Okay. Like directly they may ask you haircut. So all you need is initial margin. Inverse it, -1. All good, everyone? Yes. Then directly all the formulas start from price and yield. Now, again, when I did the revision, I actually covered in depth what is inverse effect, coupon effect, maturity effect, convexity, pull to par. Pull to par means a discount bond will reach to par, premium bond will reach to par. So not everything is justified by just the formula, but still one formula which is very critical is the clean dirty price. What is the clean price, dirty price? Everyone, clean price or dirty price. And in between both, you have something called accrued interest. This happens when you sell the bond between the two coupon dates. Now, I would like to mention you that in reality, there is a detailed calculation for all, but I'm more interested in the in the names. Clean price is also called flat price or quoted price. Correct? It's the listed price, flat price or quoted price of the bond. Dirty price is also called full price or invoice price. Remember these two. Accrued interest is unique because it is the interest till date. So T over T into coupon. I will tell you what is T, the big T and small t. So T over T into coupon. Now what is this small t and big T? So first of all, the smaller t here represents the time since last coupon. Time since last coupon. So let's say last coupon was paid 30 days back. And if it's a semi-annual bond, how much is the duration between coupons? 180 days, semi-annual. So the small t is 30 since last, and the big T is 180 days. So it's the time since last coupon into the coupon amount. Everyone with me? Correct. So you have to adjust the coupon for the time, that is the accrued interest. It is the coupon accrued till now. Small t, that is the time since the last coupon. It's written here from the date of the previous coupon, and big T is the total time between the two coupon dates. Is this clear, everyone? I have mentioned these formulas also, but you don't need these formulas at all. Okay, the PV full, PV flat, those formulas are not needed. You need to know the names. And which price will be always higher? Full price, dirty price, or invoice price, that will be always higher. Remember that, okay? And do remember the names. Accrued interest formula, yes, you can remember that. Clear, everyone? All right. Now, guys, there is a formula of effective yield or effective annual rate. Even though there is a formula, we don't need it. Can you tell me why? I'm writing down the formula, effective annual rate. But why did I say we don't need it? Because what function do we use? Yes, actually they say YTM breakdown. Let's say it's semi-annual bond. So I will break down into semi-annual, then plus one. All of this is, I'm sorry to say, but for me, this is all stupidity. But no disrespect here, but you have the second two function. So you don't need that. So but still, just for formality, I will write down to the power n minus 1. This is nothing but the same concept of nominal and effective rate. And what you will do is that you will simply press second to do the nominal and effective rate. Just remember the compounding frequency. If it's semi-annual bond, it is 2 quarterly and so on, right? 4 and all. Remember here one small thing, that the nominal rate is nothing but the YTM. So nominal rate, YTM, stated rate. That's where the confusion is. So you have to make sure that the bonds effective rate are same if you want to be indifferent. The bonds effective rate should be same. Okay, everyone clear? I'll repeat. You don't need the formula because we have second two function. Now, current yield and simple yield, yes, current yield also called as the coupon yield. Current yield and coupon, also called coupon yield and simple yield. Now, remember they're different from YTM because they ignore the time value. Current yield only takes one component and simple yield takes both. Now, when you invest in a bond, you get coupon. So current yield only takes the annual coupon over price. Simple yield takes coupon and the price difference. So what I will suggest you to remember simply, just take the annual coupon. Even if it's a semi-annual bond, you will take the annual coupon over the price. Remember this. I'll repeat, even if it's a semi-annual bond, you will take the total annual coupon because you're finding yield for the year. Simple yield also has annual coupon over price. Annual coupon over price, correct? But simple yield has one more thing. What is it? It's the price difference, which, see, in the notes, in the formula notes, it is capital gain or loss over n. What I generally tell students, the easiest way to remember is the difference between FV and PV over n. That is the easiest way to remember. FV minus PV over N. Remember this, future value minus present value over N. It is also called amortization of discount or premium, capital gain and loss, average. Again, you can write the official formula, but since in exam, no one's going to ask you the formula, you should know what is that. That's the difference between buying and selling price divided by N. That's your capital gain. Is this clear, everyone? Simple yield and current yield. All good? They are not the same as YTM. YTM takes time value. Now comes one of our very important thing, callable bond. Now, before I discuss callable bond, let me discuss that the value of which bond is always higher. Value of, there is a straight bond. Straight bond is also called option free bond. There's a straight bond, value of callable bond, and value of puttable bond. Please tell me which bond's value is always higher. Puttable bonds value is always greater than straight, which is greater than callable bond. All right. Yield opposite, correct? So the difference between the straight bond and the value of callable bond is due to what option? The call option value, isn't it? So if they ask you what is the value of call or call option value, remember the value of call option is nothing but the difference between the both. Everyone clear with me on this? Right? You can also check the notes. Call option value is nothing but value of option free. Option free is also called straight bond minus value of callable bond. Now, even though you don't need for your exam the put option value, but guys, we will be ready to do it. Put option value is, guys, what? Value of puttable bond, because that bond's value is higher, minus value of straight bond. Straight bond is also called option free bond. The difference between both is due to the put option value. With me, everyone? Okay. Value means the option value or option price. The difference between the two is due to the option feature. So why is the value extra or low? That is called option value. Got it? So if they ask you what is the call value in this, that extra call value or put value is due to the option feature. Got it? Now, see, there are some formulas related to what? The YTC. Now, normally, in order to calculate YTM, what all do you need? Please tell me. What do you need to calculate the YTM? Is the present value of the bond correct? Yes or no? You need the N, you need the PMT, that is the coupon, right? You need the FV, and then you calculate the YTM. But in order to calculate YTC, of course, you will need the present value, but the N is the call time or the call whenever it is called, right? PMT is same, but the FV here will be what? The FV here will be the call price. Are you with me? These two things will change. Check and confirm. What two things will change in YTC? The N and N will be your holding period or the call time. And what will change? The FV. Because when you sell off, you will get the call price. Clear, everyone? Now, what is yield to worst? In this, what is yield to worst? Yield to worst is the highest or lowest? Everyone, lowest yield amongst all yields. All yields means I include YTCs and YTMs. Amongst them, whichever is the lowest, that is called yield to worst. Good, everyone? Right? Understood, everyone? Check, confirm. Right? Now we'll discuss about the spreads. Spreads. Ready for the spreads? Okay. Yes. Now there are two spreads which are based on YTM, and the other two spreads are based on yield curve. What is YTM? It's a flat yield for maturity, and yield curve means for each maturity there is a different yield. Both are same or different? Our students know, are they YTM and yield curve, are they same? No, it's different, right? Correct? All right. So G spread and I spread both are based on YTM. Very good. And G means government. That is what we use, treasury. I spread means interpolated or swap spreads. Swap is also interbank spread. So we are always comparing the YTM here, YTM of our bond, and we are assuming our bond is a corporate bond. Okay. Because we are calculating yield is only, spread is only for a risky bond, correct? Corporate or a risky bond. Minus, we say what? Treasury. In this case, I will say treasury yield. Why treasury? Because it's a government spread, G spread. And here we use the swap rate. Swap rate, everyone, is the interbank rate. In the past, we used to take LIBOR. right? Now you can take any other reference rate, which is also called market reference rate. So that is a swap rate. I spread is also called interpolated spread. That's why it's called I. Understood, everyone? But the two other yields are based on yield curve. Now, first of all, whenever you find the present value of the bond, guys, we take what? Coupon for year one, coupon for year two, and in year three, we get two things, right? Coupon and the FV. We don't do it manually in the calculator. We don't do it manually, but we use the PMT function because coupon is same. We don't use PMT function in equity because the dividends are different. We discount all of them with what? 1 plus 1 year spot rate, 2 year spot rate, 3 year spot rate. Remember? But what if I add a constant spread of let's say 20 basis point to all the period, and then I do to the power 1, 2, and 3. So that constant spread over the yield curve is called what? Z spread. Are you with me? It is calculated using trial and error. I will just give you a hint. There's a less chance probably asked in exam, but in case if asked in exam, how will you do it? Everyone, please understand this. In case if asked in exam, it's a lengthy process, but how will you do it? A very simple way. Are you ready? Everyone? Check, check, check. Online guys, ready? In real life, you have to do what? Do trial and error. But in exam, you have three choice, right? So what you do, you have the spot rates, add choice one, let's say 20 basis point, add 20 basis point to the spot rates and find the present value of bond. If the present value doesn't match with the price that they give, use the second option. Add, let's say 30 basis points. So add 30 basis point to the yield and then discount and find the present value. Of course, after two, you will get to know if it is not matching, the answer is third. Understood? I have rarely seen such questions, but my student should be ready. What you do in the spot rate will be provided to you. Coupon and FE you have. You will add the three choices given. Z spread 1, Z spread 2, Z spread 3. Whichever matches the price is your Z spread. Z spread is due to the risk of the bond. Higher the risk, more will be the spread. Everyone. But for callable bonds, do we take the Z spread into consideration? Very good. For option embedded bond, we use what? Option adjusted spread. Option adjusted spread is higher or Z spread is higher? Remember, always Z spread is bigger. So Z spread is always higher. Correct? Z spread is always higher. So the difference between a callable bond Z spread and option spread is due to option value. So option value here, guys, for a callable bond, we only focus on the callable bond. Will we add or subtract from the Z spread? Online guys, will we add or subtract? We will subtract. Why am I asking? Because in exam, they may probably ask you which spread is higher or lower. Correct, everyone? Check, confirm. So if the Z spread is 40 basis point, option adjusted spread is 30 basis points. So that 10 basis point is due to option value. Is this correct? Clear to the class? Crystal clear? I don't want anyone to make mistakes in this. We work very hard in fixed income. Fix the marks. Check, confirm. Please make sure you get 70 plus in fixed income. The bigger the mountain, the faster we nail it. Right? Good. Online guys, come on. Where's the energy? All good? Written? Yes, very important, the spreads. Now I will discuss the quoted margin and discount margin. This is about which bonds? Floating rate bonds, right? Floating rate notes or floating rate bonds. Remember, for floating rate bonds, for floating rate notes or floating rate FRNs, they may use floating rate notes or floating bonds, simply whatever names they use, floating rate bonds. In this case, I have something interesting to discuss. First of all, the coupon and the yield. Will they be fixed or they will keep changing? They will keep changing, right? So you have a market reference rate or the benchmark rate, which is common. So we write here the reference rate. I call MRR. The CFA Institute also calls MRR, market reference rate. Now, the thing is that what about the other thing? The other thing maybe an addition or subtraction, doesn't matter, but we'll write it simply addition only. Two margins. Coupon is called quoted margin, and for yield, we call discount margin. For yield, we call discount margin. Everyone with me? And guys, if the quoted margin and discount margin are same, what will happen? The yield and coupon will be same, yes or no? Quoted margin is for coupon. So I will write coupon and yield will be same. Then the pawn price will be at par. But if the quoted margin is greater than discount margin, remember coupon will be greater than yield. Am I correct? And when coupon is greater than yield, bond price is at, come on, tell me. Bond price is at, everyone, premium, correct? Premium. And if the yield is more than coupon, and when will this happen? When the quoted margin is below the discount margin. So the yield is higher. In this case, the bond will be at discount. This is an extra thing that we did in the class, right? Not everything is in the formula, but don't worry, everything is in my notes. Crystal clear, everyone? Floating rate bonds. In this topic, we have two things, floating rate bonds, and then there is these yields. Money market yields, very highly testable. And actually, you will notice it is nothing but holding period return formula. FVPV, FVPV. Now, the easiest way to remember the three yield, what are the three yields? Discount yield, very good. Add-on yield and bond equivalent yield. All the three are money market yields. And remember, in money market, the only difference is due to the price. There's no coupon, correct? Less than 1 year. So what is the common way to remember? All of them are based on the discount. What is the discount? FV minus PV. The redemption value minus the investment value. Correct? FV minus PV in all of them. So in the numerator, you will always see the FV minus PV. Remember, money market instruments are always below price, below par. Why? Because they are issued at discount, redeemed at par. All of this FV minus PV over something into 100 to convert into percentage, and we will annualize it. That point we will come in a moment. Now, discount is always on the face value. So we divide it by face value, but yields are always on the investment, that is return. So that is both on the basis of PV. Is this clear to all? Right? Now comes the annualizing part. This is where things get interesting. So what we do, we always annualized based on days. So we take 360 over days, 360 over days for discount and add-on yield. But for bond equivalent yield, my class will tell me we do what? 365 over days. Correct? So add-on yield, if I multiply that with 365 over 360, so that will become what? Bond equivalent yield. Isn't it, everyone? Understood? And remember my logic through which you will not have to calculate which yield is always bigger and which yield is always smaller. Discount yield, add-on yield, and bond equivalent yield. Remember which yield is always bigger. Come on, guys online, let me know. Bond equivalent yield is always bigger than add-on, which is bigger than discount yield. Keep this in mind. It will help you answer any question. These are all money market yields. One of my favorite And when I say my favorite, mean of course institute's favorite also. See, whatever troubles you will be asked. Understood? Students ask me, what will be asked? I say, what is troubling you? That will be asked. Easy. What is not troubling you? You are anyways not worried, right? So what are you worried? That will be asked. Got it, everyone? Correct? Now, in this reading number 9, we don't have formulas. Just for your reference, spot curve, par curve, forward yield curve, you will see a formula, but they are all discounted at some rate, spot rate or all. Just remember, a par bond is one where the yield and yield and coupon are same. All right? Correct? Yes. In between, what is the spot and forward rate? Very important. How do we find the forward rates? And first of all, I want the entire class to tell me when I write forward as, what are the forward notations? Let's do some notations practice here, guys. Correct? So, what is 1y, 1y? Read it. Everyone, online guys should answer as well. What is 1y, 1y? It's 1 year rate after 1 year. So, what are the rates that you will have? 0, 1 and 2. It is 1y, 1y. 1 year rate after 1 year. One more thing. What if I tell you what is 2y, 3y? Correct. It's what? 3-year rate after 2 years. So how many rates you need? 0, 2, and 5. So it's a 3-year rate after 2 years. With me? Correct? So if it's, let's calculate this because there's no formula as such. So I will write down. If I want to find F2y, 3y, what rates I will use? I will use the adjacent rate. So I will use the first 2 year. How will I write this? 1 plus S2 square because it's 2 year. Into, I will write 1 plus F 2y, 3y. This is for how many years? 2y, 3y is for how many years? No, 2y, 3y. How many years? Check. So I should write to the power 3 because it's a 3-year rate. Doesn't matter when it starts. It's a 3-year rate. Should be equal to what? 5-year rate to the power 5. Everyone with me? Correct. Remember, the power should match. 2-year rate, then 2 to 5 is 3-year rate, should be equal to 5-year rate. This way you can solve any particular forward. Is this clear to the class? Check and confirm. Spot forward. All right. Guys, just for your reference, when we find the present value, even though I already did it, let's say if it's a 2-year bond, in order to find the present value, I will either use the spot rates, correct? Or instead of spot rate, I can also use the forward 1 plus S1 into 1 plus forward of 1 year after 1 year, correct? So either you can find present value using spot rate or forward rate. Should the answer be different? Should the answer be different? No. Only rounding off issue is there. In exam, be ready to find the price of the bond using spot or forward. How is it? Good? Interesting? Right? See, I will tell you one thing about the formulas that we do is that we use the same formula irrespective of what the concept is. So what happens? Let the institute come with any twist. We are not going to change our process. But you know what happens sometimes? Students see CFA Institute's explanation, and with all due respect, that explanation is sometimes confusing, and students are like, sir, I don't understand their explanation. So I tell them, ignore their explanation, do it in your way or our way that we did. Don't try to match their explanation to explanation. Their process may be different. Okay? Cool, everyone? Clear? We've finished the first phase. In fact, second phase, I divide the fixed income in 5 phases. The first phase is introduction, the initial reading still government issues, then the pricing, then the risk, then credit risk and securitization. Yes, you have to be specific. Tell me, what is your question? Yes,
The
you can
last
unmute and
one.
ask. Yes, please.
The last one.
Can
This
you be
which
a
you
bit
have
loud, loud,
replicated.
a bit loud? I can't hear you.
Can you hear me now? Am
Yes,
I?
go ahead. Yes.
I am asking the last one which you have
Hmm.
replicated
Hmm.
1 plus S1 into 1 plus F.
1 year after 1 year.
Okay.
Because for
Okay.
2 years, you need what? First year spot and then F11, like this, 1Y, 1Y. You see this? So I need 1 year rate. This is what? F11, 1 year forward after 1 year, right? Correct? Got it? All right. Perfect. Now, don't give up in between. Let's focus on the risk. Now, interest rate risk and return. There are two elements which are very important here is the horizon yield, and then there is Macaulay duration related duration gap. Although the durations I've discussed separately, and in the class I've discussed what to do with holding period return or when the realize and YTM are same. This is something that I would suggest you to go through the explanation. It's very well, amazingly described. But the two formula that you should know here is the horizon yield and the duration gap. So let us focus on the risk part. First, we will discuss what is horizon yield and what are the different names, horizon yield or realize yield. Actually, you will notice it is nothing but holding period return only. So what we do to find the horizon yield or realize return or realize yield, we just take simply, you will notice in the syllabus, it is ending value of your investment divided by the beginning value. And here we pull out all the returns, we accumulate the coupon also. I'm going to find it difficult to explain without the question, but this divide to the power 1 over n minus 1, that n is the holding period. Now, this all is one way. The other way is you can use what? You can use the PMT function. So what we do is that we use the PV, we use what? We use the FV, we use PV and FV. We don't put anything into the PMT. Now, those who have done these questions with me, they will probably relate this. And then what we do, N is the holding period, and then we compute I by Y. So it is the same technique, just that you can do it manually also. Realized return is the actual returns on your investment. It is not the same as YTM. You compare it with YTM to find whether the realized returns will be higher or lower. In the class, we've discussed this technique without calculation also. So without calculation also, you can identify whether it will be higher or lower depending on the information given. Apart from this, the other important formula is duration gap. Very important, duration gap. Duration gap. Duration gap is what? You compare the two things. You compare your investment horizon with the Macaulay duration. So duration gap is nothing but Macaulay duration minus the investment horizon. Minus the investment horizon. Remember, if the investment horizon is lower, duration gap is positive. If the investment horizon is higher, duration gap is negative. Macaulay duration, very important. Are you ready for all the durations? Check and confirm. In the notes, I've clearly mentioned what is the use of duration. Macaulay duration is used to find what? The weighted average time it requires for bond to repay from its cash flow. It's like a payback period. But then we adjust the duration to make it like a sensitivity called modified duration, which is only appropriate for small change in yield. So then we calculate another duration called approximate modified duration, highly testable. But this is for option free bonds. So then we calculate effective duration. Are you with me? All these durations and why? Macaulay duration is something that we do in a tabular way. What we do is that we calculate the weight of the bond multiply with what? Weight of the bond multiply with the time, and we sum it up. So it's a time weighted return. Weight of the bond is nothing but the present value of the bonds divided present value of each cash flow divided by the present value of the bond. That is your Macaulay duration. Everyone with me on this? How do I get modified duration from Macaulay duration, guys? We take the Macaulay duration, and we do what? We adjust it with the YTM. Assuming it is annual YTM, we adjust it with YTM annual. If it is semi-annual, you will make the YTM half. Is this clear, everyone? Modified duration online, guys. Check, confirm. What is the use of modified duration? Modified duration works like a sensitivity, like a beta. So modified duration is used to find what? Change in the price of the bond. Remember, it is modified duration that we use to find what? Percentage change in the price of the bond. I will repeat, modified duration we will use to find percentage change in price of the bond is nothing but modified duration into percentage change in yield. Remember, duration is modified duration, or duration is always negative. Why? Because there's an inverse relationship between the yield and price. Between yield and price, the relationship is inverse. Is everyone clear with this relation? Change in price just because of duration. This is called duration effect. Change in price of the bond due to modified duration, it is called duration effect. So what I do, I take the modified duration, multiply with change in percentage change in yield, I will get what? Percentage change in price of bond. So that's what we use modified duration for. Approximate modified duration, very important. What is approximate modified duration and how it is similar to effective duration and how it is different? First of all, approximate modified duration, everyone in the class? Why do we use it? For a larger change in yield. So we take the changes in the price. So PV minus PV plus difference. Now here, guys, the minus and plus on the top represents what? Price of the bond when the yield goes down. Price of the bond when the yield goes up. And because of convexity effect, you know this will be positive. The difference will be positive. PV minus minus represents yield drop. Plus on the top represents yield increase. Divided by what? 2 into PV0, the beginning price, into what? Into what? Into the change in YTM if it's a approximate modified duration. But effective duration, we use the same concept. PV minus and PV plus 2 into PV0. Everything is same in effective duration. Where is the difference? Yes, we do what? Change in yield curve, or simply the curve. We use the curve in the denominator. That's the only difference, no difference in calculation. Is this clear, everyone? Key rate duration doesn't have a formula. Key rate duration is used to find a specific maturity risk. Just for your reference, remember all of these are parallel shift in the yield curve except key rate. Key rate is non-parallel shift. Are you with me, everyone? Now, what I will do is that I will also calculate the convexity formula here, approximate convexity. So guys, if there is approximate convexity, let me calculate here itself. What is approximate convexity formula, which is testable, everyone in the class? In that also we do what? PV changes, minus and plus, both we add and we subtract 2 PV0. 2 PV0 divided by PV0 into what we do? We do percentage change in yield square. Remember, if it is approximate convexity, it is YTM. If it is effective convexity, just the Y will become yield curve. So I'm not writing two different formulas. It's the same concept. Just that instead of YTM, it will become yield. Is everyone clear with me on this approximate formula for convexity? Confirm. So all the durations and convexity at one place. Guys, the most important formula now I'm going to write is percentage change in price of the bond because of duration effect and convexity effect. Convexity effect. Now remember this duration and convexity effect. Duration effect means what? Due to duration. How much is the effect? Due to duration, we do modified duration into percentage change in yield. Yes or no? This is the duration effect. All right. And the convexity effect, which everyone should know, and this formula is so highly testable, it is half into convexity into percentage change in yield square. Is it square or not? Square, right? Everyone clear with duration and convexity effect? Check and confirm. Just remember, instead of change in yield, they may give you change in spread. The formula remains the same. So change in yield, change in spread shouldn't matter. Okay, even if they give you change in credit spread, you still have to apply those basis point and multiply. Your calculation will not change just because of the name change. Is this clear? But guys, now if I want to find the dollar change in the price of the bond, then I will do what? I will do what? Everyone. I will perhaps do everything same, just a small change I will do. Can someone tell me what is that change I will do? Yes, if I want to find the dollar change, we do what? Money duration. Yes, please tell me. Yes, very good. In place of modified, we will use what? Money duration. Excellent. And here we will use money convexity. Are you with me on this? This will give me the dollar change in price of the bond. And now we will understand how to derive money duration and money convexity. Remember money duration and money convexity. Money duration and money convexity, very easy. Whatever modified duration you have, or whatever convexity you have, only one step we have to do to convert it into money. What do we do, guys? We multiply that with the price of the bond, with the full price of the bond. Simple. Everyone with me on this? In the notes, I've written it well in the well manner, but this is how you can easily relate. Check and confirm. In exam, if they ask you money convexity, don't get panic. Just take the convexity multiplied with price. Money duration, just take the modified duration, multiply with price. What is the use of it? It tells you the dollar duration or dollar convexity. All right, everyone. See, in exam, they may ask you based on total or based on a single bond. If they ask you based on a single bond, you will take individual bond price. Let's say the total bond value, is 1 million, the face value. Okay. And the total price of the bond is, let's say, 950,000. So the price of individual bond is how much? 95. Correct? For per bond, per 100 bond price is how much? 95. So if they say on the per 100, 95 into the duration or convexity. If they say on total, just take 950,000 into duration or convexity. Is this clear to the class? Don't get panic just because there's a name change. If you get panic, what will you do? Nothing you can do there, right? So no point. All good, everyone? Now, something which is highly testable, PVBP, price value basis point. In this case, you will take two prices difference, and average it. Simple, divide by 2. Which price? So we will decrease and increase the yield. So we will do what? We will do the change in yield for 1 basis point. So you will find price twice. 1 basis point up, 1 basis point down. Only 1 basis point. How much is 1 basis? Guys, How much is one basis? If there is 100 basis is equal to 1%. So one basis is going to be 0.01%. Is that clear to the class? Right? Remember, change in one basis point up and down, the difference in price divided by 2 is PVBP. It tells you the change in the bond price due to one basis point change in yield. Very, very highly testable. Believe me, or don't believe me, up to you, but still very important. Correct? All good, everyone? All the durations, convexity, change in bond price, percentage, dollar, money duration, money convexity, PVBP. I've used almost all the dangerous stuff here. Convexity has two formulas, right? We are not doing that. We are for exam, we are doing approximate convexity only. I already did this. Just the difference is that instead of change in yield, you might have change in spread. Everyone with me on this? Clear? One formula we have is duration of the bond portfolio, similar to weighted average. What is portfolio duration? Portfolio duration, same like there are two methods, but the one which is calculation is same like weighted average. Weight of bond A into duration of bond A, weight of bond B into duration of bond B, and so on, depending on how many bonds you have. Simple weighted average return, weighted average cost, weighted average duration, same formula. Everyone with me on this? Check, confirm. Confirm. Effective duration, effective convexity, only that in the numerator, everything is same. In the denominator, just we do change in curve. They are used for option embedded bonds. Key rate duration doesn't have the formula. Okay. Empirical duration is past. All the duration that we measured are called analytical duration. All the different types of duration that you calculated are called analytical duration. Anyone has any question for me till this point? Check and confirm. Right? Everyone, this section, you have no idea, it is so important. These 2 pages that we did, the last, duration, convexity, so important for your exam. Couple of formulas from this section. All right. Now, don't give up. Stay tuned. Credit risk related formulas. Credit risk. In this, even though there might not be too many calculations here, but in credit risk, one important formula that you should be aware is the different part components of the risk. But before that, what is expected loss? Very important. Expected loss is a combination of two things. What are the two things? Probability of default into loss given default. Are you with me? So if there's a default, how much is the loss? And loss given default is nothing but loss severity. And loss severity is nothing but 1 minus recovery. So loss given default is loss severity. Loss severity means how much percentage of the money you will lose if the bond defaults. And loss severity is opposite of what? It is opposite of 1 minus recovery. Remember, 1 minus recovery rate is loss severity. Correct? So let's say you are exposed to 100 million of bond portfolio. Of that, if the loss severity is 40%, recovery rate is 60%, multiply that with the probability of default, you will get your expected loss. Check and confirm with me. Expected loss, probability of default into loss given default. Loss given of default is nothing but the loss severity into the exposure if you want to find exactly. So loss severity is percentage or dollar. If it's dollar, it's same as loss given default. But if it's percentage, you'll have to multiply with the exposure. That will give you the dollar loss. Multiply with probability of default. Everyone clear with this? All right. Perfect. Expected loss. Now, the credit spread. What is the spread? We already discussed what is the spread. Spread is the difference between your bonds YTM and the benchmark. This spread can be divided into two parts. Actually, the total yield spread, the total spread is divided. We did the spread, right? G spread, everyone. So total yield spread is due to what? Is due to credit and liquidity. So we write down one interesting thing. Total spread. Total spread is equal to what? Total spread of the bond is due to what? Credit and liquidity spread. Now of this, we actually calculate what? Total spread is nothing but we know. What is total spread? Total spread is the difference between the bonds YTM and the government bond YTM. So we take the YTM of our bond minus the treasury. Correct? YTM of our bond minus YTM of our corporate bond or risky bond minus treasury. That spread will be provided to you, everyone. Liquidity spread is when you calculate YTM twice. Once you will calculate YTM using bid rate, and then you will calculate YTM again using ask rate. Which price is bigger? Bid or ask? Ask price is bigger. So ask price YTM will be lower. So the difference between both, is called your liquidity spread. The difference between both of them is your liquidity spread. So guys, credit spread is actually the balance. So credit spread is what? From the total spread, you will subtract the liquidity spread. Are you with me on this? Total spread minus liquidity spread. That is going to be your balance. In exam, they may ask you to find this in percentage. So what you will do simply, if the total spread is 100 basis point, liquidity spread is 60 basis points, so 60%. The remaining is credit spread. So the missing here is credit spread. There's no direct calculation of credit spread. It is the balance or plugin. Is this clear? Everyone with me on this? Check, confirm, check, confirm, check, confirm. Now, in credit analysis for corporate issuer, the credit rating agencies do check at some of the ratios. Now, these ratios of that one unique ratio that is RCF to net debt. What is RCF? It is nothing but retained cash flow. So actually apart from the ratios, all the ratios are similar to FSA. Only two things are unique here: retained cash flow and FFO. So I will write down those two ratios. What is FFO? FFO. The easiest way to remember FFO is CFO. CFO is what? Net income plus non-cash charges like depreciation minus what? Minus what? Changes in working capital investment, correct? FFO is much easier. FFO ignores the working capital. So it is only net income plus non-cash charges. Working capital is ignored. That is called FFO. Got it? FFO, net income plus non-cash. Working capital charges we ignore. Are you with me on this? Check and confirm. Free cash and others you know. Retained cash flow. Retained cash flow. As the name suggests, retained cash flow is your cash flow. Whichever cash flow you take minus dividend. You will pay the dividend and the balance is retained. And guys, if they say net debt, what is net debt? Net debt is what? Net debt is total debt minus the cash. The company has cash and short-term investments. So we will subtract that minus what? Minus the cash component. You know why this is important in real life? Because some companies like, let me tell you, if I say Apple has a debt of $2 billion, is it too much or too less? $2 billion debt Apple has. Too much, right? But the cash it has is more than $100 billion, then too less, right? So we don't look at only debt, we do look at net debt. You know what happens in our country? In our country, they say, oh, the big company, they borrowed $100 billion, but they might have cash of more than that, right? So we always, as analyst is the one who doesn't analyze from reels, who doesn't analyze from Instagram. He looks at the actual financial statement. Got it, everyone? Clear? Is there anything else in securitization? Wow, the good thing about securitization is there is no formula for securitization. Just one thing, remember the spread. Excess spread is what? There's no formula. Just remember in the securitization, the one who is starting the process, originator, they get money or interest or rate of return from the borrowers. And then what they pass to the investment bankers is lower. So they might be getting 5%, they pass only 4%. So that difference is their spread. Okay, it's not a formula needed, but that's it. All good, everyone? All of them do not have a formula, but there is some discussion, not calculation, but I will discuss about weighted average coupon and weighted average maturity. Okay, and some ratios. These are not formulas but ratios. So now what we are going to do in the securitization, we are going to discuss the ratios. So what is weighted average coupon and weighted average maturity? Remember, in a securitized bond, is there one bond or multiple bonds? Everyone, multiple bonds, right? So what we do, we multiply the weights of each bond, and I will tell you what is weight, and multiply the weights of each bond with coupon, that is called weighted average coupon. We multiply the weight of each bond with its maturity, and then we get weighted average maturity. Very less likely they may ask you to calculate, but still we should be ready. And weight, what is weight? Weight is nothing but the outstanding amount on bond. Let's say outstanding amount of bond 1 over what? Total outstanding of all bonds, isn't it? Over what? Total outstanding of all bonds. Outstanding of all bonds. Correct? Simple. So let's say outstanding of bond 1 is $100. Total outstanding is 1,000. So it's 10% weight. So outstanding, how much is yet to be paid off? That is outstanding. That will give you weight. And with that weight, for each bond, you'll multiply with coupon to find weighted average coupon. With maturity, you'll find weighted average maturity. Is this clear for the securitized bond? Now, in the securitization, I have something to discuss about the two ratios which we have already calculated, but slightly different here is that for a residential mortgage, we look at two ratios, loan to value and debt to income ratios. Which ratios we use? Loan to value and debt to income ratios. Now, the name itself is the formula here, everyone. Loan to value ratios is loan amount over the value of your asset. All right, loan to value ratio, it is always what? Below 1 or above 1? It is always below 1. Correct. Debt to income ratio is what you're going to pay on a monthly basis in terms of installment over your monthly pre-tax gross income. So we take monthly payment on debt over pre-tax gross monthly income. Pre-tax gross monthly income. Gross monthly income of the borrower. Okay, the one who's applying for the loan. Now remember, loan to value ratio, lower is safer for the bank. Debt to income ratio, lower is safer for the bank. Clear? This is under residential mortgage. Under residential mortgage, remember, it is the borrower's paying capacity which is important. But under a commercial mortgage, you will see something similar. You will also see loan to value ratio, but you will see another thing that is called debt to service coverage ratio. Now, debt to service coverage ratio is for a commercial mortgage. So I will write debt service coverage ratio for a commercial mortgage. This is important because in commercial mortgage, it is not the borrower, it is the property's earning which is important. The property's income which is important. So we take the annual NOI, annual NOI, and I will discuss what is NOI, net operating income from a commercial property. But debt service coverage is annual NOI divided by what? The debt service. Debt service can be only interest, can be interest or principal, everyone. So it is called debt service. So debt service is nothing but your installment. So it can be, in many cases, it can be only interest also if it's a bullet bond, or it can be interest plus principal in terms of payment. So that can be the case in case of debt service. Everyone, this is for commercial mortgage. Now, what is NOI? When you go to level 2, you will actually derive NOI. There's a full calculation of NOI, that from the property, whatever is your inflow minus outflow. So what is my inflow from the property? Rental income. But outflow is all the expenses. Outflow includes operating expense, non-cash replacement reserve like depreciation. All right, so we do what? NOI is nothing but rental, or we can say annual rent. Okay, so we will take the rent minus what? Cash operating expense. Now, just for your reference, I know it may not be needed in level 1, but cash operating expense includes maintenance, repairs on your property, correct? And we also subtract depreciation. Depreciation. Okay. All of this is your NOI. So guys, maintenance, repairs, taxes, property taxes, all of that are subtracted from cash operating expense, right? And any depreciation is also subtracted from the rent. That is your NOI. NOI divided by debt service is debt service coverage ratio. Yes, check and confirm. Everyone, how was it? The massive 19 readings. Woof. Fixed income. You know what about fixed income? If you see, you don't have to memorize all these formulas, but when you do twice or thrice, you get to know all of them. All good, everyone? Any questions about fixed income? Check, confirm, check, confirm. All good? Okay. Yes. Now, let's start with derivatives. In derivatives, there are a lot of formulas, but beyond formulas, the concepts of derivatives so amazing. These 10 readings, 5 to 8% weightage. Majority of the formulas are somewhat related to options, but before that also you have a very common formula that you've already done in the past, which is related to the no arbitrage forward price. So it's actually later on. After arbitrage and replication, there is no arbitrage forward price. So first, I will discuss the no arbitrage forward price. Then I will do the pricing and valuation. That is the most important formula, right? So pricing and valuation, I will do no arbitrage forward price and then value of the forward. So no arbitrage forward price, assuming no benefit or cost, it is simple. Spot into 1 plus risk-free to the power T. Everyone with me on this? If there's a benefit, we will subtract the benefit. If there's a cost, we will add back the cost. So if there's a benefit, what do we do, guys? We subtract the present value of benefit. We add the present value of cost, everyone. And then we compound to the power what? Into 1 plus risk-free to the power T. All right, this is how we find the price. Remember, the price of forward and future is done using the same process. I'll repeat, the price of forward and future, the process is same. Value under the contract. Yes, value means what? Value means here it's different, right? In derivatives, it's gain or loss for long. Remember, the valuation is always from the long throughout the derivatives. So that's the difference between spot and present value of forward, for which in the class I have put up three scenarios. Value at inception, which is always value at inception, that is T0, when your time is 0 at inception, when at maturity, the big T, and then can be any time before maturity. So can be any time before maturity, right? I write it less than T. So let's say it can be 12 months contract, 3 months before maturity, etc. Now, very important, value means the difference between the long short price, correct? So the long has booked a forward contract, and whenever the long will square off the contract, on that day, what is the spot price? At inception, the spot minus the present value of forward. Minus the present value of forward. There is a full maturity. On maturity, on the last day, the spot on that day and the closing forward price on that day. And before maturity, we do spot minus the forward divided by what we do. We divided the forward by the remaining maturity. So you will do 1 plus risk free to the power T minus T. Now remember, the big T is, let's say, 12 months. The contract is for 12 months. And if you're settling them just 3 months before maturity, 3 months before maturity. So the big 12 months, everyone in the class, 12 months is, let's say, the entire contract period. If I'm settling the contract at the end of 9 months, so the difference between 12 and 9, that is 3 month only compounding is there. Here, the most interesting thing is, guys, at inception, the value of forward, future, and swap. Tell me, at inception, it is always 0. Forward, future, and swap, all. Later on, if the prices go up, there can be gain for the long. If they go down, it will be loss. So later on can be gain or loss. Understood the pricing and valuation of forwards? Everyone, I have written it properly here in the notes also. You can check it out here. Value is always gain and loss for the long. At inception, it is always 0. During the life, it can become gain or loss for the long. The price is the no arbitrage formula price. The same thing we did in currency. In currency, the forward is as per interest rate parity. Remember, interest rate parity, spot into 1 plus interest rate of price over base. So it's the same formula, but about currencies. In commodities or in derivatives, we will learn in alternatives, when it comes commodities, we will learn that spot plus the cost minus the benefit in present value into 1 plus risk free. Remember, cost includes storage cost. Storage cost, which is not with equities. With equities, there is no storage cost. But with commodities, there is a storage cost. Benefits, guys, benefit are monetary and non-monetary. Monetary benefit is like dividend or coupon, which is with financial assets. Physical assets have non-monetary benefit. It is called convenience yield. So there is a cost and there is a benefit. Cost is insurance cost, storage cost, holding cost. Benefits can be monetary or non-monetary. When we will do alternative investments, at that time we'll discuss the non-monetary benefit is with commodities. Is this clear, everyone? In the class, check and confirm. All right. This is all about the pricing and valuation, very highly testable. Next. Now, value and price of forward rate, FRA, forward rate agreement. Forward rate agreement pricing is same as the spot forward rate that you derived, the forward rate using spot rate. So it is same as the forward rates you derived using the spot rates. Same formula we did already in fixed income, correct? So that's not the difference here. It's the same formula. You will see here Z are spot rates. You don't have to remember this formula at all. It's the same formula. Now, sometimes you may require this. I have hardly seen many questions related to this, but there is an FRA payoff. This is value of the contract. So when I say value of the contract under FRA, it's always for the long FRA. Long FRA. Long FRA is like the one who's expecting rates to go up or down. What is long FRA expecting? Long FRA, the one who has taken a long forward contract, is expecting the rates to increase. Everyone. Now remember, before I put up the formula, FRA. Everyone. If I put FRA 30 by 90 FRA, what is 30 by 90? Means after 30 days, I want to borrow for additional 60 days. So the underlying maturity is at the end of the underlying maturity is how much duration? 60 days, which will end on 90th day because it will start after 30th day. So in FRA, we book a rate which is called FRA rate, and then we compare it with the LIBOR or the market reference rate. So we compare the two rates, market reference rate and FRA rate. If the market reference rate goes up, the long will make money, right? If the market reference rate goes up, let's say we book the FRA at 5% and the market reference rate goes to 6%. So the long FRA will make money. But all of this is calculated on a notional principal. Why do we say notional principal? Because do we exchange the principal, guys? Do we ever exchange the principal? No. All of this is calculated on notional principal. Here, please take care if it is in days, I have to convert the rates into days. So it is going to be days over 360 or 365. The institute will mention it, but otherwise FRAs are for 360 days. 360 or 365, don't worry, it will be mentioned. Guys, here in my case, how many days will be there? What is the duration of this FRA contract? The underlying loan duration? Can you guess and help me? Right? How many durations here in this example? 30, 60 or 90? Yes, 60 days. Therefore, we will discount also with 60 days because FRA are settled year on 30th day, not on 90th day. So what we will do, we will discount the FRA 1 plus MRR into, we will use the same days over 360. So we will discount because we are going to settle them earlier, right? FRAs are not settled on 90th day. They are settled on the 30th day in my example. All right. If the rate goes up, it's benefit for the long. If the rate goes down, it's a loss for the long. Am I clear, everyone? May not be tested in level 1 exam, but this is definitely tested in level 2 exam at a high probability. So please use this example or this formula for your reference. Okay. So guys, everyone cleared with forward pricing, valuation? Got it? Right? Now for arbitrage, there is no formula, but I would like to put up the arbitrage process. What happens in arbitrage? We compare the actual future prices with the no arbitrage future or forward prices. If they are higher or if they are lower, what is our conclusion? If the actual future price is higher or lower than the no arbitrage future price. So if they are higher, what is our conclusion? Yes, please tell me. We will say a decision is what? A decision is whether the future is under or overvalued. Yes, please help me. Whether the future actual future price is higher than no arbitrage future price, we will say the future price is overvalued. Correct? If the actual future price is below, we will say undervalued. Undervalued. Am I correct? So we take three positions based on this. Can anyone help me? What are the three positions? The three position, we say the future prices here overvalued. Otherwise, we say undervalued. Now, whenever I say overvalued, what are the position that we take in futures today? Simultaneous position we take in the spot, and for borrowing and lending we go to money market. Everyone with me? And based on that, there will be gain or loss, which is already decided. I'll repeat. We take a position in futures, simultaneous position we take in spot, and then we go to money market. May not be asked in calculation, but you should be aware about the steps. So if the future is overvalued, we will short the futures today, long the spot. On maturity, we will square off. And since we long in the spot, in money market, we will borrow at risk free. If the future is underpriced, we will long the futures, short in the spot. And since we short in the spot, we will invest in the money market at risk free. If this is the case, the arbitrage gain is already decided. The arbitrage gain is the difference between the actual future price and no arbitrage future price, because future was overvalued. If it was undervalued, the difference between no arbitrage future price and actual future price, because future was underpriced or undervalued, that gain is certain. Is everyone clear? I'm again repeating, you may not be asked to calculate, but you should know the positions based on the comparison of no arbitrage future price and the actual future price. Same for forward and future, doesn't matter. Everyone with me? Clear? Pricing, valuation, forward and future is same except for the margin, which we will discuss. All good? Anyone has any question till this point? Are you writing? I hope you are writing. If not, it's okay. You can check out the notes as well where I've mentioned all this thing. Perfect. Now there's no formula, but replication. Replication is what? Similar to a derivatives position. So we do what? We do replication. I'm writing it. I know it's not a formula, but still, let's make the maximum utilize of this time. So we are taking an alternative of derivatives. So remember, in derivatives, you do long forward or short forward. How is that done in the underlying? Everyone. So when I say long forward, or when I say short forward, the pricing or the outcome is same like taking an underlying position with the borrowings. Now I will borrow when I am long the forward or when I'm short the forward. When I'm long the forward, I will borrow. So it is like long an asset, and short forward is like short an asset. Asset, I am writing S0. S0 is the current price, right? Long an asset and short an asset. But what is borrowing called as? If I say borrowing is also called long bond or short bond. Borrowing is also called long a bond. Are you there online, guys? Borrowing is what? When you borrow, you sell a bond. So it is called short bond or short risk-free bond. Long risk-free bond. Long is investing, right? Everyone? No formula here, but just for your reference that what is long short. And guys, the difference between this long and short should be equal to risk free, because what is the difference between long and short? Everyone, if I do long an asset and I hedge it means I short the derivative of it. So guys, if I, let's say, if I take a long contract in derivative, right? If I do long forward and simultaneously what I do, if I long an asset and short an derivative, or if I long a forward and short an asset, doesn't matter. So here we will say long an asset, let's say S0. And if I do short what? Short the forward of the same asset. Short the forward. The difference between both is due to risk free. So my return will be equal to risk free rate. Throughout the derivatives, what is the difference between price today and price later? It is due to risk-free rate. Am I clear? Risk-free rate. Good, everyone. Arbitrage, replication, pricing, valuation. Even though pricing only may be asked, pricing and valuation, but still. Now, when it comes to future, just remember one thing. Where do we have mark to market? Mark to market is in futures. So in futures, the price every day will be a new settlement price. And unlike forward, futures can be settled daily. Futures are in fact settled daily. So after the settlement, the gain or loss is adjusted. So in futures, the value after settlement each day is, come on, tell me, value under the futures after settlement each day becomes zero. Clear? Okay. So no formula, but you should know this. Now, swap. There are two parties in a interest rate swap, plain vanilla swap, floating and fixed. Floating and fixed. So remember in swap, the pricing of swap, very important. Pricing of swap is the fixed rate, guys, the fixed rate, at which what will happen? Everyone in the class, the rate at which present value of payment fixed payment and present value of floating payment will match. I'll repeat, the rate should be such that the present value and the floating payment should match. So the present value of all of the floating payments and the fixed payment at the rate at which they match is called swap fixed rate. That is called the swap fixed rate. Are you with me on this? Right? And the valuation, pricing is rate. The valuation is from the point of view of whom? When I say the value of swap is from the point of view of whom? Always the fixed rate pair. Always the fixed rate pair. The valuation is always from the fixed rate pair. Everyone, fixed rate pair. So fixed rate will pay fix. Pay fix. So the present value of fixed payment, this is what will be his outflow. And present value of floating pay, that will be his inflow. So the difference between both will be the gain and loss for the swap fixed rate pair. At inception, this will always be equal to, come on, at inception, the value for forward, future, and swap at inception is always zero. So the rate is in a manner that at inception it is zero. Later on, if the rate goes up, long FRA and fixed rate pair will make money. They will make gains. Understood, everyone? Correct? So tell me one thing. In swap, when I say fixed rate pair, can I also say simultaneously this guy is a floating rate receiver? Yes or no? And a fixed rate receiver is nothing but similar to a floating rate pair, because opposite is the case, right? In a swap. Okay, the reason I'm doing is to help you with the replication. You know what is replication? How can I replicate a swap? So guys, every time I say pay means we have issued a bond or we have invested in a bond. When do you have to pay coupons? When you have issued a bond. So we say short. Whenever you say pay, that means short. Short which bonds? Here in this case, short fixed rate bond. And here short floating rate bond. And whenever I say receive, guys, receive is when you have long the bond or invested in the bond, correct? So receive, you will receive the coupon when you long. Which bond? Here it is set floating. So I will say floating rate bond. And here I am fixed rate receiver. So I will say I have long a fixed rate bond. Are you with me on this? The same thing I've written here. What is the pay fixed, receive floating, and vice versa. Whenever you pay fixed, you are a fixed rate payer. That means you issued a fixed rate bond. Receive floating means you invested in a floating rate bond. Cool, everyone? We've already discussed value for fixed rate payer. It's difference between floating and fixed rate leg. Swap is nothing but a series of forward contract. Swap is nothing but a series of forward contract. All good? Ready for the amazing topic of options? Options. Yes. Options. What is the payoff for long call? Or simply, what is the call payoff? And what is the put payoff? Yes. Call payoff. Can someone help me? It is maximization of something, right? Maximization of ST minus X. ST is spot at maturity minus X. X is a strike rate or 0. And put is X minus ST or 0. Am I correct? Everyone, this is my payoff. But guys, if I say profit and loss, if I say profit and loss or gain and loss for call and put, remember profit and loss for call and put is nothing but the payoff minus the premium, which is call premium or put premium. All of this that I calculated is for which position, long or short? All of this is from Long's point only. Why? Because everyone in the class, come on, tell me, be participative in the class. I feel I'm all alone. Guys, Long's point of view only. Why? Because we are always thinking from the Long's point of view. Do you know the technique in exam that whenever they ask you for gain loss or payoff, you always calculate from the Long's point of view. But if the question says short, just change the sign. Just change the sign. Just change the sign. Clear? Let me know what is the premium made up of. Premium is made up of two components. Can you tell me which two components? Intrinsic value plus time value. And intrinsic value is the amount by which the option is in the money. In the money. So if the option is in the money, intrinsic value will be greater than 0 or less than 0. And if it is out of the money, intrinsic value will be greater than 0 or less than 0. Out of the money or even at the money. Come on, tell me. If the intrinsic value is in the, if the option is in the money, intrinsic value will be always greater than 0. Otherwise, it is 0. It is never negative. It's positive intrinsic value if it's positive if it is in the money. Otherwise, 0 if it is ATM or OTM option. Time value depends on the time. So before maturity and after maturity. So I will write for time value maturity before and after. Before and after. If it is before maturity and on maturity, not after, rather on maturity. Remember, before maturity, time value is positive. On maturity, time value is 0. Is this clear to the class? Everyone in the class? Check, confirm. Intrinsic time value. Very important. Okay. Yes. Any questions? Premium is always equal to intrinsic and time value. Intrinsic depends on whether the option is in the money or not. Time value depends whether the option is matured or not. Can premium be negative? No. Premium will be 0? Yes, only if the option is expired and it is ATM or OTM. Only then the premium will be 0. Everyone with me on this? Check and confirm, check and confirm, check and confirm. All right, all right, all right, all right. Now there is bounds of option. You can choose to skip it and focus on the impact on the option. Remember option and you should connect now with the alternatives also. Underlying, see, anything which increases the stock price will benefit the call option. Anything which decreases the stock price will benefit the put option. So underlying asset, exercise price is opposite relation, but underlying asset increasing will benefit the call because the prices goes up. Risk free also, time also, benefit no, benefit reduction, cost yes, right? Volatility is friend of option. So volatility, higher the volatility, higher is the chances that the option will expire in the money, call and put both. Time, remember time is also friend of option. Time actually depletes. So higher time is better, except for one option. Which option? European put option. For that, time is a bad sign. Why? Why? Because European put option, the longer the time, the more you have to wait. Everyone with me? Now, please focus on the put call parity. What does the put call parity match? Two things it matches. Yes. S0 plus P0 equals to C0 plus present value of strike price. Can you tell me what are these positions? 1, 2, 3, 4. Yes. What are these positions? This is long underlying asset or long a stock plus long a put. This is long call and this is long zero coupon risk free bond which pays X or strike price on maturity. Remember, all these are long positions, but if you want to replicate, if you take on the other side, the long will become short. These positions do have a name which you should very much remember. What are the names of this position? The first one is called protective put. Protective put. And the second one is called fiduciary call. Remember, the payoff of both is always same on maturity. That's why we call put call parity. And in this, if I replace the spot with present value of forward, because you know, based on time value, spot and present value of forward are same. Rest all if I put as it is, rest all if I put as it is, C0 plus present value of strike price. If I put as it is, this becomes what? This becomes put call forward parity. Okay, so there's just a change in name. Put call parity and put call forward parity. I just replace the underlying asset with the forward, present value of forward. So easy, right? Everyone? Think it this way. Clear? Check, confirm. Right? This is the formula that you should know. Now, guys, this part we already discussed in corporate issuer that investment in equity is like a long call and investment in debt is like a short put. Long call because equity will benefit when the value of the company increases. Debt will lose when the value of the company falls. So it's like long call and short call. This we already discussed in corporate issuers. Now comes the most important thing of this topic is the binomial and hedge ratio. First of all, I will discuss what is the binomial option pricing model. Binomial option pricing model. Under this case, we find the value of call or put, but let's say we have the spot price and then we find out what will happen if the prices go up or if the prices go down. Based on that, we will get the call or the put value. Let's say call value if it goes up or down. These are expected values. What we will do, we will discount them, but we need to find the risk neutral probability of upside and downside, which we will discuss. Once you get that, you find the expected payoff. Expected payoff is nothing but the call into the probability of upside, call price once the prices goes down into the probability of downside. This is what you will get on maturity. If you discount them with the appropriate risk-free rate for the maturity, when you do that, you get the present value of call, which is your intrinsic value of call option. Same you can do for put. Understood, everyone? Here, to compare the payoff, you will always use strike price to check whether the option will be exercised or not. Most important thing is in the formula of probability of upside, which is the risk neutral probability. For this, they will provide you with some data, but you require what? You require 1 plus risk-free rate. That is the risk-free rate in factor minus the down factor. Down factor is the percentage of stock going down. Everyone, down factor is adjusted in the numerator and denominator. In the denominator, we take the up factor minus down factor. This is called risk neutral probability of upside. This is what students should remember. For example, if the stock is expected to go 20% up, the factor will be 1.2. If it is expected to go 20% down, the factor will be 0.8. Correct? That will give you probability of upside. 1 minus probability of upside will be your probability of downside. Check and confirm. Right? That will be used in the formula here. And then finally, hedge ratio. Hedge ratio. What is the use and what is the formula? First of all, hedge ratio is nothing but the change in the option due to the change in the underlying. So we write, let's say, change in the call due to the change in the underlying asset. For example, let's say the increase and decrease in the call divided by the increase and decrease in the stock price. So when the stock price goes up and when the stock price goes down, what is the difference between both? That range is called the hedge ratio. Hedge ratio does give me what? Hedge ratio tells me the number of shares that I need to buy or sell to hedge against option. I'll repeat. What is hedge ratio? Hedge ratio. Hedge ratio gives me what? The number of shares, underlying shares that we need to buy or sell to hedge the option position. Just for your reference, everyone, please understand this. If you have a long call, is it bullish or bearish? Long call is bullish. Similar to that, short put is bullish, right? These are your option positions. These are your option position, correct? And similar to that, if I say short call is bearish and long put is also bearish. So what does hedge ratio tell you? That how many shares you need to buy or sell. That shares or underlying asset that I need to buy or sell, that will be how many, that hedge ratio will tell you. But what position should I take? You should take the opposite position of option. So if your option is bullish, long call. So what is the bearish position in underlying asset? You will short the underlying asset. Isn't it? Short the underlying asset. But if it's short call, long put, which is bearish in the underlying, you will long the underlying asset. Is this clear to the class? Done. Check, confirm, clear. All the formulas of derivatives. All right, amazing. Cool. Any questions till this point? All good? Yes. Now, when it comes to alternatives, remember alternatives, the most important thing that is tested in exam, hopefully, is the returns on your investment. Yes. But before calculating returns for the LP, limited partner, we need to find the fees for the to be paid for the GP, general partner. Now, everything is mentioned in my notes, but I will just give you a hint because as such, there is a for formality, there is a formula which you will see in the later topic. That is, how do we calculate the returns? You will see the leverage returns. And for fees, there is an official formula also. What is the total fees? What is the returns? But do you require this or not? I will discuss with you. Okay. So just remember that structure 2 and 20 means 2 is management fee, 20 is incentive fee. But is incentive fee sure or not sure? Incentive fee is subject, it depends, right? It is contingent. So therefore, we write whether incentive fee will be paid or not, like an option payoff, zero or something. All right. So we will discuss that, but I don't want you to understand through the formula wise. I've used the formula here, but we will learn it in a different way. Okay, we'll discuss that. Before that, let me just discuss this because we've already covered leverage return and money weighted or time weighted return. These are the performance measurement. They are the performance of the fund. One unique thing is money multiple, which I will write down here, and then we will go on the fees calculation. So what is money multiple? Money multiple, yes, is how much times your money has multiplied in the alternative investments. So this is a combination of what you have received until now and what is still in the fund. So check out very interesting thing, the total capital returned by the fund plus what is still in the fund. So it is total capital return, total capital return, capital returned by the fund plus value of assets still in the fund. Remember, value of assets. What are the assets still in the fund? Remaining assets. So value of assets remaining. These are still invested in the fund. Now, all of this based on your investment, based on your investment. So this does not take time value of money into consideration. This only tells me how much times my money multiplied, right? So capital paid over the life of investment. So all the capital paid over the life of your investment, right? Again, you may have seen very less calculation related to that. Majority of the calculation is about the fees and everyone what? The returns. First, I will tell you the broader answer for is total fees are inclusive of what? Management fees, everyone. Management fees and management fees, which is always there, and incentive fees, which is also called performance fees. Now always remember, incentive fee is contingent even if I'm writing here. And returns are based on what is the ending value of the fund, minus the beginning value of the fund, minus all the fees, minus the total fees divided by your beginning investment in the fund. Everyone with me? Correct. So that's going to be your return. Of course, into 100, you will calculate into percentage. Returns are always calculated for GP or LP. Returns are for LP and fees goes to GP. Is that clear to the class? Understood? Cool. Now, not a part of formula, but I will discuss what goes into management fees. Now, there's no formula that I'm discussing. Management fee is calculated either on the basis if it's hedge fund and if it's private equity. In hedge fund, it is always, let's assume for our simplicity, guys, here, what I will assume 2 and 20. Let's say 2 and 20 for our example, okay? 2 and 20. 2 and 20, which means what? How much is the management fee? 2%, and 20 is the incentive. I'm using it as a reference. So management fee is 2% of what? 2% of what? In hedge fund, it is 2% of asset under management. In private equity, it is as a percentage of committed capital. Remember, not invested capital, committed capital, paid annually. But which AUM, beginning or ending? Beginning or ending? Beginning or ending? My students know what do we do? Do we use beginning or ending? Do we apply our own brain? No. Let the institute mention you in the exam. Is this clear? Clear, clear, clear? Beginning or ending? For hedge funds, it is percentage of AUM. Private equity, it is percentage of committed capital always. Beginning or ending, the institute will mention. This is your management fees. Now, for incentive fee, again, I will write down, there is no formula. Okay, I'm just incentive fee. I'm just discussing incentive fees. What all you need to check? First of all, incentive fees is always on the gains, gains or profit. The problem is how to calculate the gains. The basic formula is ending minus beginning, ending value minus beginning value, right? But it depends on several factors. If there is a hurdle, guys, I will write down. If there is a hurdle, there are two hurdles. Remember what hurdles? Soft and hard hurdle. If it's soft and hard hurdle, ever in the class, if it's soft and hard hurdle, then in the soft hurdle, let's say in case my gains were this, if there was no hurdle, nothing, I would have calculated here, we've taken 20%, right? I would have calculated 20% on the gains. Now remember, when I'm calculating on the entire gains, this is what? This is soft or hard? This is what? Soft hurdle. Are you with me? On the entire gain, soft hurdle is good for GP. If it's hard hurdle, it is ending value minus the hurdle. And hurdle value is what? Let's say if it was 5%. So until the fund reaches 105. So it is still the hurdle. And then on that 20%, are you with me on this? These are no formulas. These are just concepts that you should have in your mind. Check and confirm. All good? Everyone in the class understood this? Check, confirm, check, confirm. Now, please understand this, that in the same case, if they say net of management fee, then what will I do, guys? Then I will subtract the management fee also, isn't it? If they say net of management fee, then from the gains, I will subtract what? The management fee also. Management fee that will increase my fees or reduce my fees? That will reduce my fees. So this is if they say net of management fee, net of management fee. So from the total gain, you'll subtract the management fee also. But if they say independent of management fees, in that case, we will use the standard formula, which I just showed you. Correct? Everyone? Check, confirm, check, confirm. All right. Yes. Remember one more thing. If there is a high watermark clause, if there's a high watermark clause, if there's a high watermark clause, then will your incentive be full or less? Your incentive will be less because then it is calculated only on the gains above the high watermark. I'll repeat, incentive only on the gains. So you will take the ending value minus what? The high watermark value. Watermark is the previous highest peak, high watermark value. On that, you will calculate the gain, the incentive. Is this clear to the class? Every detailed check, check, check. Total fees is then management and incentive fee. And then put up all of that fee, subtract it from the ending value. Finally, multiply that with 100. That will be your returns for the LP. Check, confirm. Everything that I could think of, I've put here. For your reference, I've used this amazing table. Yeah, I'm saying amazing because it really will help you, right? Which is beneficial for what? For whom? Perfect. In the deal by deal, remember in individually each deal you calculate, whole of the deal you calculate for the total gain and loss, which is good for whom? We've already discussed that. All good till this point? Check, 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 check. Now, if you see throughout the syllabus, there is only formula which is respect to commodities, which we already know. All right. I have seen a question or such a long question. You can always unmute and ask, is management fee also subtracted by calculating return basis higher watermark? Now that depends. Maybe you haven't attended the session. Again, always it depends whether they've given net or independent. They will provide you that. There's nothing by default assumption. If they provide you net, always subtract the management fee, irrespective of watermark or not, irrespective of soft or hard hurdle. Fees, deduction or not, is not relevant to soft, hard, high watermark. So from the gains, should I deduct the fees or not? That is not related to, again, hurdle or high watermark. That you always have to deduct if they say net. Okay, it doesn't matter. Clear? Yes, cool. Okay, yes, perfect. Don't worry. Just do a couple of questions. It will be good, right? You're not going to get more than 2, 3 questions on it. Maybe maximum 1 or 2 only. Okay, lucky enough if you get more because it's relatively easier. It's more logical. Now we already did the no arbitrage forward price, so there's no need to repeat this formula. Just remember there is a cost of carry, which is cost of capital plus storage minus convenience yield. Based on this, I will discuss something. So what is net cost of carry? And if you want, you can write the no arbitrage forward price again or future price. So future price is what? Spot price into 1 plus RF to the power T, that is nothing but, if I say 1 plus risk free, that is cost of capital, plus the storage cost, everything in present value terms, if and then take it in the future, or everything take it in the future. So storage cost, and when I will subtract the benefit here in commodities, that benefit is called convenience yield, the benefit of physically holding the commodity. All right, everyone. The formula net cost of carry includes cost of capital here, the time value of money or the cost of money invested, storage cost, and convenience yield. Of this, the entire focus should be on storage cost and convenience yield. That is called net cost of carry. Now, if the storage cost is greater than convenience yield, or if it is lesser than convenience yield, yes, help me with this. If the storage cost is greater than convenience yield, what will happen? Future prices will be greater or less than spot. Future prices should be greater than spot, otherwise less than spot. If the future prices are greater than spot, we call the market is in, only the name changes, contango, otherwise we call backwardation. Everyone with me? Contango and backwardation. Check if the prices are increasing, it's contango, otherwise if it's decreasing, backwardation. Cool, everyone. Check, understood. Right. Rest, the topic doesn't have formula, including digital assets and all. There is no formula. That's it. Convenience yield is negative. How is that possible? Please tell me, how is convenience yield negative? Convenience yield is the benefit of physically holding the asset. Convenience yield is positive. It is subtracted from the no arbitrage forward price. Physically holding the commodity has a benefit. Convenience yield cannot be negative. It's a benefit. Understood? Convenience yield is a non-monetary benefit. Understand? Don't think it always from the mathematics point of view. Think it logically. Storage is a cost. It's always going to be positive. Convenience yield is a benefit, right? Positive storage is a cost, so it's negative, but we add it in the formula. Convenience yield is always a benefit that will reduce the price, forward price. All good, everyone? Check, confirm. Okay, yes. This is where we end up alternatives. Now we start with portfolio management, and this is where you understand how the first topic of QM and the last topic and everything is connected. Now, the first reading, which is about overview, in this we have a ratio called diversification ratio. Diversification ratio. Now, diversification ratio, first of all, the lower the ratio, the better it is. If you check in this, it compares two things. It compares the standard deviation of what? There's a standard deviation of portfolio and standard deviation of the stock, which is a part of the portfolio. Let's say that stock name is I. So the standard deviation of portfolio with the stock and divided by the individual standard deviation of that security. Okay, now what more detail it does it have? It is saying that a portfolio which is equally weighted, standard deviation of portfolio which is equally weighted. Now this is the drawback of this model, that it assumes equal weighted, and divided by what? Divided by the standard deviation of that individual security from the portfolio. The security is security standard deviation. The security I is from I from the portfolio itself. Okay, I is a security from the portfolio, so it's a standard deviation of that security. Now if that security is added to the portfolio, its risk, overall risk, should reduce, not increase. So remember this ratio, lower is better. If it is lower, we say there is a diversification. So remember the two things. If there is diversification and if there is no diversification, if the ratio is equal to 1 and if the ratio is less than 1, we want less than 1. If it is 1, means no diversification. No diversification. Are you with me on this? Correct? If it is 1, that means there is diversification. So lower the ratio, everyone, higher is the diversification. This is clear, everyone? Even though it may not be tested in calculation, but you should know the meaning of it. Then a basic formula of risk premium, everyone knows risk premium is returns minus risk free. Okay, so that is one easy formula here. We are not discussing that. We already know risk premium is what. What is the other formula that you need to know now? It's not a formula, but a very interesting thing that I tell students, that there are open-ended mutual funds, closed-ended mutual funds, and ETF. Remember, open-ended mutual funds, closed-ended mutual funds. I hope you are writing with me. And then there is ETF. Okay. Open-ended mutual funds are valued at NAV. Closed-ended mutual funds can be at premium or discount. Generally, they are at discount because they are locked. Discount to NAV. But ETFs are close to NAV because there are market makers which will buy, sell to make sure the ETFs are, by the way, sold on the exchange. So exchange price. So the price, ETF price is exchange price, which is close to NAV. Now, always remember, if the exchange price is higher than NAV we call it as premium. If it is lower, we call it as discount. So if all of this measured based on NAV into 100, we can find the premium discount in percentage. In case if they ask you premium discount in percentage, you can always take the exchange price minus NAV over NAV. Remember this, it's not a formula, but you should know open-endeds are valued at NAV published at the end of the day. Closed-ended are can be premium or discount officially. Practically, they're always at discount because of the lock-in. And ETFs are close to the NAV because there are arbitrages trying to match them. Is this clear to the class? Right? This is your first reading overview. Your second reading perhaps has no formula as such because there is a lot of discussion related to different types of constraints in the IPO and objectives, risk return, and then the constraints about TTLLU, time, tax, legal, liquidity, and unique circumstances. All right. The main formula starts from reading number 3. This is where you will see majority of the formula similar to what we did in quants. So let us repeat some of them. It's okay to repeat. We know portfolio return. Now everyone assuming two securities, portfolio return is weight of A into return on A, weight of B into return on B. But now see what I do. A two-factor portfolio, two-factor means what if one of the security is risk free and the other is a risky asset can be market also, even that is called portfolio return. But if you notice that this portfolio return and everyone please notice the two fund separation portfolio return, the process is same. It's just that A and B I'm replacing with risk free and a risky asset. If it's a market portfolio, risky asset can also be replaced with a market portfolio, that is RM. All right, this is my portfolio return. Very easy. No problem in this. Portfolio risk. Risk is always calculated in variance converted into standard deviation. So portfolio risk, we already did that in quants, but let us repeat. Weight of A square, variance of A, weight of B square, variance of B, and 2WA, WB multiplied with covariance AB. Covariance AB can also be replaced with what? This can also be replaced with a with what? Correlation AB into standard deviation A into standard deviation B. All of this into root. If they ask you standard deviation, if they don't ask you standard deviation, you can keep it as it is. Please remember, there is a shortcut for the portfolio risk. Portfolio risk formula shortcut that depends on the correlation. If it is exactly +1, -1, or 0. What is that shortcut? It is simply A plus B. So it is weight of A into standard deviation of A minus or plus weight of B into standard deviation of B. The formula is same, just that if there is correlation exact minus, that is perfectly negative, this will become the lowest risk. If it's 0, the third component becomes 0. So it is weight of A square variance of A plus weight of B square variance of B. And the third component, everything becomes 0. So this still remains the root. Everyone realizes this? One very important element that can I make portfolio risk 0? Yes. What is the condition? Portfolio risk 0 or a zero variance portfolio. The condition I will put is and, means I need both the things. What both the things? I need correlation to be exactly -1, that lowest, and the weights should be optimum. Optimum means it doesn't mean that at any weights, means there will be a combination at which the portfolio risk will become 0, but both conditions are together essential. If only one of the condition is matched, your portfolio risk may be lowest but not 0. Is this clear? Correlation of -1 and optimum weights. Only that will make your portfolio risk 0. Clear, everyone? Now, please understand, if your two assets are, let's say your A is a risk-free asset and B is a risky asset, then in that case, portfolio risk. Why for 0 we root? Oh, I have a question. Let me address that. Now, tell me one thing, portfolio risk. What will happen if this entire component, if the correlation is 0? What will happen in that case? Only the third component will become 0, right? What about the first two? It will remain as it is, right? Correct? The first two will remain as it is. Only the third component becomes 0. Understanding? Why that component becomes 0? Because correlation is 0. So the third component, this part will become 0. Got it? Clear? Yes. Perfect. Clear? The third component becomes 0 if correlation is 0. Now, if there is one asset which is risk-free and risky asset, remember the portfolio risk. Now, risk-free asset, what is the standard deviation of risk-free asset if nothing mentioned? Standard deviation of risk-free 0. So now remember, in your portfolio risk, everything where you had, one asset was risk-free, everything will become 0. So if you check here, and those students who were with me, they know we've derived this. Let's say if A is standard deviation of A is 0, this will be 0 and the last part will also be 0. So I will be left with what? I will be left with only the risky asset weight of risky asset into standard deviation of risky asset. Everything in square and root will become this only. Please remember this. This is what the compressed version is if there is a risk-free and risky asset. Is this clear, everyone? Check, confirm, check, confirm. This concept of risk-free and risky asset creates a line which is called capital allocation line. Capital allocation line. Now, based on this, we calculate what? We calculate what? Capital allocation line. And then there is capital market line. In capital allocation line, we create a portfolio of risky and risk-free asset. But in capital market line, we assume markets are efficient. So we create a portfolio of risk-free and market index. Market index. In both the cases, my formula for expected return is RF plus something, right? That is something is nothing but risk premium we use in CAPM, right? Here, we will use a simple thing if it is my related to my security or my portfolio. We generally write the Sharpe ratio of our portfolio or security, RI minus what? I will do RF over what? Over what is the Sharpe ratio? Over the standard deviation of that security. This, wait and see what I do, everyone. This, I have to do it simultaneously so that you understand it. And multiply this with what? The standard deviation of what? The standard deviation of the portfolio. This is an individual security. And then I multiply with the standard deviation of the portfolio. But if it's capital market line, you will notice it's the same thing, but instead of any random or any individual, portfolio or security, we take the market. We take market as the asset. So instead of individual asset, what we take? Market. So here, what will happen? I will take RM. RM is nothing but the market portfolio. This is what is the twist when you do in this reading and in the next reading when you do CML. That's the difference. Now, guys, CAL is for individual investor, but if the market is efficient, we consider one single portfolio, that is market portfolio. What is this called as? This part is called as, everyone knows what is this part called as? Sharp ratio. Sharp ratio. Everyone with me? Clear? This may not be really tested in terms of calculation, but you should know this is expected returns using expected returns using CML and using capital allocation line. Remember, both of them uses total risk. Do we do the same for CAPM? In CAPM, do we use total risk? Guys, tell me, in CAPM, do I use total risk? When I do CAPM, in case of CAPM, which we've done, right? We also calculate what? Expected return, but we use the same components, RF plus RM minus RF we use, right? But do we take total risk? No, we take only the systematic risk, that is beta. Right. And beta, we all know what is beta. But first of all, what is the two types of risk? We learned that from linear regression also. Total risk, everyone, total risk is a combination of systematic risk plus unsystematic risk. I'm writing in short form. Total risk is systematic and unsystematic. Unsystematic can be diversified by buying more and more securities. Systematic cannot be diversified. So if you add more and more security, which risk will go down? Unsystematic risk will go down. Are you with me? Correct. Quickly tell me beta formula. We discussed that beta is nothing but covariance over variance. In linear regression, XY we use, right? Here we will say covariance of stock and market over variance of market. If there is covariance, if there is correlation, we do correlation into standard deviation of what? Correlation of stock and market into standard deviation of the stock over the standard deviation of the market. It's the same formula, same formula. Don't be worried. It's just that instead of covariance, I replace that with correlation. Is this clear? Everyone in the class, check and confirm, check and confirm, check and confirm. Now, please see here, everyone, we did capital market line and capital allocation line is similar. You should remember capital market line, which is using the Sharpe ratio of the market. I don't expect that to be highly tested in exam, but still you should know. And that is the slope of CML. Slope of CML. Now, before CML, I will also discuss, we know CML and we now know capital asset pricing model. These two things we know, right? CML and capital asset pricing model. Along with capital asset pricing model, there are other models also which are single index model. No, do not go into memorizing them. The only one I expect student to memorize is CAPM, which we all know by now. But there are other models also. Now, what you should know about these other models? They similarly look like linear regression, right? A plus B, B1, B0 plus B1 into B0 into X, correct? Plus error. Do you remember this? It's similar to linear regression, everyone, right? Everyone, y equals to b0 plus b1. This is nothing but y equals to b0 plus b1 x plus error. Remember this from linear regression? It's the same thing. Now, market model and security characteristic line, in that we check the risk premium, risk premium of the stock and market. So it's just rearrangement of the formula. If you notice here, if I take risk free on the other side, it is just rearrangement. Again, you don't need to memorize it. What you should perhaps focus on, that are these using single beta or multiple beta? Single beta. So they are all single factor models. Multi-factor model is where we use more than one beta, beta 1, beta 2, beta 3 into risk premium. Pharma French uses 3-factor model. Carhart uses 4 factors. Do I have to memorize the formula? No, but just remember, more than one beta, it is called what? Multi-factor. It can be due to company specific, it can be due to stock specific. Gerhardt uses four-factor model. The fourth factor is momentum. Momentum is a technical indicator. So I'll repeat, I'll very clearly say, do I need to memorize all the formulas? No, just remember more than one beta is called multi-factor model. Multi-factor model. Pharma French uses three-factor. Gerhardt uses four-factor. Everyone should know CAPM and everyone knows CAPM. What is the most important? Before I go ahead, first of all, like portfolio duration, what is portfolio beta? Yes, tell me, what is portfolio beta? Simple, weighted average, weight of A into beta of A, weight of B into beta on B. Simple, like portfolio duration or weighted average return, right? Now, I want the class to help me. Are you ready to help me? Right? There's no formula, but you have to tell me what is the slope. Give me the three slopes, sorry. Slope of CML, slope of what? CML, SML. SML is security market line or CAPM, and security characteristic line. These are my lines. And what is the slope of it? Slope of CML is nothing but the Sharpe ratio of market. Sharpe ratio of market. All right, everyone. SML, the slope of SML is RM minus RF, and the slope of security characteristic line is beta. It's in my notes, but please keep it in your head. All right, everyone. Now, final thing, we've already calculated Sharpe ratio. Similar to Sharpe ratio is which ratio? Similar to Sharpe ratio is which ratio? Everyone in the class. Similar to Sharpe ratio is Trenor ratio. These both are absolute or relative. Let me know. So Sharpe ratio, what is Sharpe ratio? Sharpe ratio and then Trenor ratio. Remember, Sharpe ratio is portfolio return minus the risk-free over standard deviation of the portfolio or security, whatever it is. And, and, and remember, for Trenor ratio, it is similar, but Trenor ratio is based on what? Trenor ratio is portfolio minus risk-free over over what? Over the beta of the portfolio. That is Trenor ratio. Always remember, they both are ratios, so they are relative. These are relative measures. Then the absolute measures. Absolute measures are what? Absolute measures are m square based m square, and then the Jensen's alpha. We all know Jensen's alpha. Okay. Everyone in the class, Jensen's alpha. What is m square? M square, do I need to memorize the m square formula? Honestly, my view is no, but still, if you want to, always remember it is risk-free plus something similar to what we already did, portfolio minus risk-free over standard deviation of portfolio. This is nothing but Sharpe ratio into market risk, Now, I will repeat, don't go on stressing on m square. What is needed for m square is important, which we will discuss. But Jensen's alpha is the difference between the portfolio's realized or actual returns minus the expected return. And expected return we use based on CAPM. Clear, everyone? Tell me one thing. What is the biggest difference? Sharpe ratios are based on which risk? Total risk. Everyone, m square is also based on total risk. Correct. And Jensen's alpha and Trenor are based on systematic risk. Is the class clear with this? Check and confirm. Everyone. Got it? Got it? Yes. SML, very important. Above the SML, below the SML, undervalued, overvalued. Please revise that. That is very crucial. Behavioral finance doesn't have formula, everyone. Risk management also doesn't have formula. But I want you to know something about this option Greeks. Option Greek is similar to duration or beta, right? It tells you the sensitivity. Delta is similar to duration, change in option due to change in underlying. Gamma is change in delta, change in underlying due to volatility, due to risk free, and due to time. That is called vega, rho, and theta. You do not have to memorize the formula, but you should know these are called option Greeks. There is a calculation of var. Do we have to calculate var in exam? No, you don't have to. But just you should know what var provides you and how is it written. For example, we write 5% daily var. If I write 5% daily var of 5% is $20,000. It gives me three things. What are the three things it gives me? Everyone, var gives me three things. Time, that is the daily amount, probability, that is the chance of the amount, and the most important is the third element, that is the minimum loss. Please write, it's not maximum loss, it's minimum loss. So how do we interpret this? Well, there is a 5% probability that my daily loss will be minimum $20,000. I can say the reverse also, 95% probability that the loss will not exceed $20,000. VAR helps us understand the downside risk, the tail risk. Again, no calculation, but you should know what is the use of it. In level 2, you will do all these calculations. Check, confirm, everyone. All right. That is the end of your portfolio, end of your CFA level 1. I'll see you in CFA level 2. Perfect. Guys, the formulas are just for your reference. The I call formula is just for formality. Uh, the objective of this was to make sure that you know all the formula nuances, and you may not realize the advantage of it right now, but when you go to the exam, you know the application. And remember, you don't have to write down anything, right? Correct. It's the easiest thing of CFA, that you just need to know the concept. All this what we are doing right now, it will recollect to you on the last day. Okay. Just a couple of instructions I want to give you, which you should remember, very important, is that three things I tell students that they should do on the last, like in the last couple of days, because most of you guys are watching this or using this formula and all when you have already done the revision. First of all, be very confident about your exam. Okay. Uh, don't underestimate yourself. You worked really hard. I always tell students, trust God, trust me if you are following me, but very important, you need to trust yourself. Don't be very depressed, what will happen. You have to be very, very positive. And this is the life's easiest challenge. Life will have more difficult challenge, so be very positive, right? Trust yourself, that is very important thing. Second, in the last couple of days, don't put yourself too much stress into doing something new, because anything new that you do is not going to help you now. Your time is now to freeze what is already learned. You need to revise it, however boring it is. Many students ask me, sir, what is the last moment thing I should do? And I very honestly, I tell them, you should repeat. And they find it surprising, but yes, you should repeat. It's boring. You will feel like giving up. I also had a discussion where I said that you will naturally feel like, let the exam finish fast, be very patient, do not skip the last few days, don't overthink, just keep on doing things, repeat the process, randomly do any topics, do solve any questions that you want, do the two CFA mocks, which are free. Don't go on buying too many practice pack unless you have, you know, I see students juggling here on Telegram and all of practice pack questions. I mean, don't be in anxiety. Relax. Two CFA mocks you have, do that once or twice. There's a high probability if it may be tested. It's a great thing. trust on what you've done till now. Okay. Now, my advice is based on if you are just a couple of days before your exam. Okay. Don't do anything new. There's nothing new to be done. There's nothing, you need to not change the entire plan or do some random new questions. Follow what you've done. Do the CFA ethics, study ethics, focus on more your weakness topics, right? Relax, enjoy the CFA. I know it's a stressful thing because you've invested a lot of money and time, right? But that's okay. Relax. Everything will come up on the last day. So, number one thing, you need to trust yourself. Number two thing, you need to repeat the process and not do anything new. Repeat what you've already learned. Number three is an advice which I will give you. And I know students may not take it lightly, but what happened with me, I will like to suggest you that I have not passed all my CFA level 1 exams in one go, right? Level 3, I took 3 attempts. I should not say wasted, but I spent 3 years in just doing level 3. And in one of the exam, I realized something and I tell students, see, right now, what is happening, as I said, you want to finish the exam early. You're just thinking that when will I finish the exams? Many of you are already thinking about travel plans, right? Where will I travel after the exam? Or will I have to join the office work? Where will I take a break? That half of your mind is occupied with that. That means you've become an analyst. You've become an analyst. You're already forecasting. Don't worry about that. Relax. You can do nothing about that. Let the you have 60 days or couple of weeks after your exam to decide until the results come. So let go of all of that. What is that I'm discussing is that one of the exam I went, I prepared the entire night because I didn't had time from my work and all. And I went into the exam and physically I can probably wake up all night and next day also I can work easily. I'm physically I can do that. But let me tell you what happened. I couldn't recollect anything. So, what is the conclusion? A good sleep is essential. A good sleep is essential. Many of you may not realize this, but you may be very healthy, fit, and fine. You may have a couple of coffee or tea, whatever helps you, Red Bull. But let me tell you, you will not recollect things. So, the last couple of days, you need to sleep well. Otherwise, your reaction will be, Sir, I was awake, everything was okay. I couldn't recollect things. And don't be in a hurry in the second part. Just because you want to wrap up the exam and go home, don't do that. Okay, relax, complete it on time. Time is not a constraint in level 1. Give your 100%. First topic or last topic, your importance should be same. I see, and it happened with me also. I just wanted to get rid of the exam and run away, and that's where I see the low score is in the last couple of topics. This is my analysis, personal analysis. I can be wrong, but that's where I tell students, don't be in a hurry to just, you know finish the exam and go home. No, don't do that. Relax. Even if you are exhausted, I know 5 hours is daunting, but this is your, put in your everything. Yes, it may not be the most important thing in your life, but as of now, it is the most important thing. So don't watch reels, don't talk to people a lot, don't text anyone. The last couple of things, stop texting. Texting takes a lot of time. Don't text, don't chat, don't watch reels. You may not never realize how many hours you've passed. Okay, focus yourself, meditate, pray, whatever helps you. Be alone, enjoy the CFA. Think your mind must be thinking a lot of positive things about CFA. Be proud about the time you've given to CFA. Pass and fail is one thing, but have you not realized in the last 5 to 6 months what all knowledge you have gained? And if you just keep the exam away for a moment, think positively that I may not have got all this knowledge if I had not done CFA. Or maybe, I realized it when I did my CFA level 1. I realized in my 5 years of finance, I never learned so much that I learned in 5 months, isn't it? So be very positive about it, right? Pass and fail, yes, is important. We from India and Southeast Asia, we have this pressure of society to pass, but we forget the fact that we need to enjoy education. And this is an education which is not forced to you by parents, right? This is something that you choose. You're managing it with your hard-earned money, with time, with office. Many of you guys are married, have kids, highly respectable, all of that. But this is the time. You can give your 10 hours, give 12 hours. You can give your 12 hours, give 14 hours. Don't take it as a burden. Take it as an enjoyment. Take it as your test of yourself. This is your reward to yourself. All right. I know this is extra gyan, but essential for students going for the battle. All good, right? I hope this has been useful to you. Thank you so much and all the best. Yes.